Yeah. Just about to start day 3 here, getting our live stream, getting everybody tuning in, hopefully for a third day in a row. Welcome, welcome, welcome. Happy Friday to everybody. It's day 3 of Tokenize This. We made it, dare I say, without a hitch. What an amazing couple of days so far. So much insights and learnings and just great people to be meeting with. And now today, we're going to take a little more of time to break into the weeds of things, to really talk about how tokenization works. We've got our sister company that you've heard about, Security Token Advisors. We actively help others apply this technology and go through this process of tokenization. So you're going to get a firsthand instruction lesson from us today. We got a heck of a day. In fact, we're going to hear very shortly from one of the leaders in the industry, one of the original pioneers, Carlos Domingo, who's coming in, will be actually live and in person for a little fireside chat with me, as well as I had the great pleasure of going over the legal process, at least in the United States, very briefly, with a great colleague of mine that we've worked with, Robin, who I've known for a long time due to my background in compliance as well. She's a Jobs Act pioneer as well. And we, of course, have a nice hour-long session of how we will, you can actually go through the steps of tokenization, the typical phases we go through with our clients, and then hopefully you can learn from what we've learned with them and have been teaching them. We also have a great session with Fusion IQ showing off their technology and their spin on how even wealth management is going to be different and changing, as well as a panel on, of course, the details of selecting a blockchain. While we're all here, maybe the biggest and most challenging component of this whole thing. And we've got folks from Provenance, from Block Time Financial, from Republic, from iComply is going to be moderating it. And I encourage everyone for that session, as well as throughout the day, go ahead and get your AMAs in. Ask us questions. This is exactly what this day is for. Hopefully we get a chance to tackle as many of them as possible. But we're not done there. As we get through our life cycle here, we do want to get into detail regarding the distribution mechanics and systems. The marketing is one of those holy grails to now evolving from just relying on closed-end networks, on brokers, on angel groups, on syndicates. Now we can actually digitally raise, we can advertise, we can use new marketing channels. How does this new world work? How do you make up your model to capture the investors that you're going to need for your fundraise? And then, of course, the other angle that everybody talks about, which is the liquidity. How do you create, as I like to say, financial services for your token now that you've actually raised money, you've got shareholders, you've got token holders, and you want to enable capabilities with your token? How do you go from there? But that's not all. We will be ending the day with a huge special announcement, so do try to stick around. Again, the virtual expo floor will be open all day as well, and we do encourage as much engagement. Again, thank you to everybody who's made it to day 3. Again, over 1,000 people have tuned in already. A huge shout out to our media partners, Securities.io and Benzinga, as well as, of course, to the sponsors that made this possible. I'm talking about Oasis Pro, I'm talking about Invenium, I'm talking about INX, I'm talking about Block Time Financial, I'm talking about Fusion IQ, Invest Ready, Red Swan, Fairchild Acquisition, and of course, the incredible team at Security Token Market and Security Token Advisors for really going through the ringer to put all of this together and make an amazing 3 days of content for you. So again, thank you for tuning in. Please take the moment to spread the word. Go check out that virtual expo floor, get comfortable, start thinking of the questions you're going to want to see answered. And we're going to start off in just a few minutes here with actually Kyle Sonlin, my co-founder at Security Token Market, as well as my co-author alongside Peter Gaffney for Blockchain Explained, where, of course, we try to give you the tools, the advisory, the research to get you into the space. But for many, it's brand new as a concept. And we're talking about investment banking, we're talking about legal, we're talking about blockchain and technology, and a whole host of other topics that you need to become a semi-expert in order to really understand what's happening with tokenization. There's an amazing glossary in here. You're going to hear all about it from Kyle Sonlin in just a few short minutes. So thank you again for tuning in, and let's have a wonderful day of tokenization.
Hello, everybody. We are into day 3. Thanks, Herwig, for kicking it off yet again with another amazing day lined up. We've got more industry leaders, more Q&As, more panels. Leave all of your thoughts, comments, and suggestions in the comments wherever you're watching this. We do have participants here on the Zoom client, as well as shout out to all of our YouTube watchers. We've had hundreds of people tuning in to the YouTube live streams each day, which is very exciting, cool to see. And so today I want to kick off our morning episode talking a little bit about the basics, because as I talked about in my panel yesterday, or certainly the day prior, sometimes everybody getting on the same page around the jargon, around some of these more fundamental concepts of the technology and of capital markets is so important in order to actually make progress in this industry. And so we believe this so firmly here at Security Token Market that we actually wrote a book on it. So as Herwig talked about, and as we've talked about here on the show over the podcast that we do for over 4 years now, a new show called the Security Token Show. We now have the conference here. We've talked about Blockchain Explained, now a bestseller on Amazon, thanks to the hundreds of people that have purchased this book. The goal here is for us to create academic content that we can use to teach in universities. We can send to clients. We can have people that are interested in learning the real fundamentals behind the technology and understanding what's actually going on. And I can start with a personal anecdote. I got involved in the crypto space back in 2013, mostly as a speculator, as an investor looking to participate in the technology. But I had another side of the industry that I was passionate about, the underlying technological components, specifically around consensus mechanisms for the actual blockchains themselves. But most of that kind of gets washed down the road because of the fact that everybody's focused on the financial opportunity of the speculation. That's what has happened over nearly a decade since that time. It feels like people only really care about blockchain technology when Bitcoin's price is nearing an all-time high, when you have access to speculative investment opportunities like the ICO and crypto craze back in 2017 that carried well through into 2021. You also had the NFT craze around purchasing art and having access to communities and seeing how that had its own bubble. And so there are all of these more retail-driven speculative investments. And that's where so much of the hype of this industry comes from, because the technology empowers liquidity. It empowers you to be able to convert these less than liquid assets into real dollars very efficiently. But the value that comes from the technology and the value that we talk about in this book has nothing to do with speculation. Really, what we're talking about here is what the technology can do to empower capital markets. So first off, when we're talking about blockchains, really the problem we're trying to solve with blockchains, in my personal opinion, is actually automating a lot of traditional financial mechanics. So when you have a capital origination event, now let's talk about what that even means. When you have a situation where a company is looking to fundraise, they are taking their product, they are the issuer, right? The company is called the issuer. They are taking their product and they are issuing stock or investment into, or assets in exchange for investment. So they're giving an investor something, whether that means equity in their company, whether that means a debt style of structure in which they are giving essentially a loan, whether you have an interest rate, whether that could convert into stock at a later date. all types of structures. You have a capital origination event. The event is where that capital injection occurs. You have an investor giving money into a business. You have a business giving stock or a debt style of note to the investor. That is your capital origination event. That process is very manual from both sides. You have the investor having to get the money into the company. And so that alone, the payments technology behind that is something that can be drastically improved. If you've ever sent a wire, even domestically, let's say here in the United States, it could take 3 to 5 days to do an ACH transfer. If you've ever sent an international wire, we step the level up one level. It can take weeks potentially in order to get that passed through. And then certainly if you are a qualified institutional buyer, you are a high institution with a significant amount of capital underlying, you're trying to move 7, 8, 9 figures of capital from one institution to another. It can take months in order to facilitate that process. Some of that is, justified. You need to do the compliance. You need to make sure, are the two parties involved in this transaction really who they say they are? But there's a lot of underlying infrastructure that makes that happen that is incredibly, let's just say, outdated. You may have investment banks that take tens, hundreds, or thousands of individuals who are basically just copying Excel sheet numbers from one side to another in order to validate the different components, especially when you're talking about scale of transactions. One transaction for $100 million might not have the compounding effects of tens of thousands, millions of smaller transactions adding up to the billions or trillions of dollars of transactions that financial institutions do on a monthly or yearly basis. So a lot of these institutions have to have significant manpower and operational expenses just to validate and justify a lot of the business practices that we take for granted as the buy side, as the end customer. When I go to Robinhood and click buy on GameStop stock, I don't see all of the work that goes into it, but yet you can feel the impacts. In the GameStop example, one of the significant problems that led to that crazy, historic, and meteoric price rise was the problem of the fact that a lot of the underlying institutions that were in charge of maintaining the record of ownership lost the location of a lot of these shares. This is a situation where they didn't know who owned what and where those stock was. And so basically what ends up happening is, and certainly in that case, there was actually over 100% of the stock that was shorted. This is a great example of manual oversight, just being inefficient compared to a technological infrastructure where you could never have a over 100% of the outstanding float being shorted, because in order to make a shorting contract, we could enforce that there needed to be both parties with local and located assets. So that's a great kind of analogy for a lot of the traditional financial infrastructure that sometimes can go wrong. So where does blockchain come into this component? Well, in order to automate a lot of these financial systems, we need to be really, really 100% certain that the information we're using is correct and it is proper. We need to track that over a period of time. Consider the provenance of that information, of that asset. You need to start at origination, as we mentioned, at that capital origination event, when that asset is structured for the first time, when the capital enters into that vehicle for the first time. We are essentially starting the big bang with respect to that asset and then going over the life cycle of an asset. We need to have each and every thing that happens throughout the life cycle of that asset needs to be recorded in a ledger or on a database that we can trust cannot be edited, cannot be changed, is the unequivocal source of truth, and is one that can be accessible by all parties that are privy to this transaction. That includes the investor originally. That includes the issuer taking on the capital. That may include intermediaries throughout the process, including a transfer agent, a broker or syndicate network that may be working with this asset, an underwriter, and other financial services providers, legal counsel, regulators, governing committees. All of these different individuals may need access to this information, and we need to be sure that that is proper, it is buttoned up, and it's very tight. So that is where blockchain provides key benefits, because once we can take that information and be sure that we know what's going on, we're sure that it is legitimate, and we are sure that it is effective, we can then automate a lot of the processes that traditionally we had to have human oversight every step of the way. In fact, a lot of the bloat and potential bureaucracy of this process is really just to safeguard the potential opportunities for failure, right? The more checks that you put in throughout the process, the higher likelihood that somebody might catch some of the problems that goes on. Not to mention that there are potential opportunities for incentives to delay this process. We see all the time that institutions are able to capitalize on float. When we talk about float, we're talking about the amount of money that is floating kind of in this void area where, okay, if I'm sending $100 million wire from one financial institution to another, and it takes 2 weeks for that process to be completed. Well, inside of that 2 weeks, one of the institutions, probably the first one, may still hold that money in a bank account while they're trying to work through a lot of the compliance and all of the details in connecting to the second bank. So over that period of time, they may be able to actually use that capital for short-term opportunities to make money off of that money that should be at another bank, but isn't due to a lot of the structures in place. This is where we talk about the increasing or the reduction, really, of settlement times, for example. When you see something as T+2, or in the panel that I had last week, we were talking about T+55. 55 days after a transaction happens is the average time that a lot of these back office transactions are settled. In that period of time, someone has the asset when it should be with someone else. So if they have the asset, someone else doesn't have it when they should, that first party may not be incredibly incentivized to send it faster, to improve this process, because they are actually potentially capitalizing on the fact that someone else is delayed. So this removes a lot of those perverse incentives when you can automate a lot of these components. When you can speed a lot of this stuff up, you can make sure that all of the compliance checks get taken care of prior to the transaction, and you can assume that all these things move forward quicker and are settled faster. So this all culminates in the idea of the real benefits of blockchain. When we're talking about what blockchain does for capital markets, it really boils down to two things. If you're a financial institution, what is your main job? Essentially, to make money. So there are two ways that blockchain can assist with that. Either in reducing costs, which in the greater context of financial and capital markets, we might consider that reduction of the cost of capital, right? So what is the cost that costs you to acquire capital for your clients? Well, if we can reduce what that cost is, whether in actual manpower and reducing the operational expenses of your business, or in speed in terms of reducing the amount of time that it takes to get that capital, both of those are costs. So reducing the cost of capital, or we have increasing the yield, increasing the ROI, increasing the IRR, the APY, these types of figures or statistics that we use to measure what is the end return. So they kind of go hand in hand. If you can reduce the costs, then it makes the rate of return higher because you're maybe making the same amount of return with a lower cost. That means that you end up with a higher profit. But potentially with automation, instead of just reducing our cost of capital, we also can increase our output. We can deliver more originations. We can create more opportunities for reinvestment because our settlement time is cut in half or cut in a third or reduced by 75%. We can then increase the amount of transactions we're doing as an institution, which then increases the top line revenue as well as reducing the costs. So there are kind of two opportunities that blockchain can reduce the cost of an institution's back office, as well as improving the client-based services and increasing the top line revenue. Both have potential opportunities, and we've actually seen both happening in the market. We've covered a lot of it throughout the event in this panel, but so much of it is detailed here in Blockchain Explained. So Blockchain Explained, I'm just going to talk through what the table of contents is here, just for anybody that's interested. We start off talking about the blockchain fundamentals. So this is the important part of what the actual technology is doing. I think a lot of people may not actually know what's going on. We use graphics, we use imagery, we explain what's going on with Bitcoin, with Ethereum, with proof of stake, proof of work, a lot of the underlying fundamental concepts of blockchain. If you're a financial institution, is this going to be crucial for your business model? Probably not, but it is important context. That's why we lead off with it, because this is what everybody's been talking about for a decade, and you may as well at least have a decent idea of what's going on so that you can sort through some of the hype, some of the jargon, and some of the BS, if we're being completely honest. Moving in, then we cover what everybody traditionally knows about cryptocurrencies and utility tokens, talking about decentralized finance, a lot of the components that are mainstream with respect to this stuff, but especially with decentralized finance, are potentially incredibly innovative, talking about what solutions we can have to automated market making, for example, which perhaps is one of the biggest innovations of DeFi, or collateralization, taking illiquid assets and being able to get a line of credit collateral on it that's funded by the community, as opposed to having to go to an investment bank. Then we talk about stable coins and CBDCs, which I believe might be the killer app of blockchain and cryptocurrency from this initial 10-year period. Is we've seen payments technology revolutionized. How can we take tokenized deposits and transition that into a payment infrastructure for capital markets, whether it's from a transactional perspective, from a buying and selling of shares using the stablecoin, or from a capital injection and investment perspective, as we talk about with tokenized dollars and debt instruments. Certainly CBDCs, central bank digital currencies, are different than stablecoins. Oftentimes, stablecoins seem to be coming from private companies versus CBDCs, or government-sanctioned central bank digital currencies. They are very different in terms of how they function, of their oversight, of their governance rules, all those different components. We have yet to see a CBDC reach the same level of market cap and market size as some of the leading stablecoins like Tether, like USDC from Circle, and others. Then we go into the real meat of the book. This is talking about commercial solutions, security tokens, and everything to do with the technology behind capital markets infrastructure. Here at Security Token Market, we have spent 5+ years talking about securities, equities, real estate, debt, all of the real exciting assets that have real value in the real world. How can we take those assets and apply tokenization technology for fractionalization to allow for anyone, anywhere around the world to invest and participate in these markets, to build healthy secondary platforms and post-issuance services like the collateralization and automated market making and other tools pioneered by DeFi? We can do a lot of those things technologically with securities. There are certainly compliance components that we need to adjust for and account for with respect to a lot of these things, but the roadmap is there. Then, to close out our book, in the final third of the book, we talk about decentralized autonomous organizations and how governance can be transformed by leveraging the newer technologies, by employing and empowering shareholders in a much more effective way than what we see in the traditional markets. We dive into NFTs, talking about what they actually are. Hint, hint, NFTs, really, that's just a quality to define an asset. Is it fungible or non-fungible? Certainly, there is a whole community and industry around art and graphics and all these types of things. But NFTs are actually much simpler than that. And anything, any financial asset could, in theory, be an NFT. We talk about all of that in the book. And we close it out with regulations, how private fundraising exemptions work, what is going on. This is, of course, not legal or financial advice, but it is our perspective over years of working in the industry. And then we talk about digital asset hybrids. This is what I mentioned with the fact that anything could be an NFT. So you could, in theory, have a security token NFT. It's a non-fungible share of a security, or vice versa. You can do a whole lot of things. You could have a utility that's tied to a security. There are all types of hybrid opportunities that we can see in the future. And then we talk about the outlook and trends for the future. And then finally, of course, at the end of our book, we do define every single term throughout the entire book. So this really does represent a textbook with respect to your blockchain 101. I've been fortunate enough to speak at the University of Miami, at Florida International University, and I've talked at universities across the country about the technology. This is the #1 resource for investors, for bankers, for financiers, for entrepreneurs, for artists and creatives, for academics, for students, for anyone to learn and truly understand in a clear and concise way everything that's gone on in the industry. I guarantee you, if you read this book, you will be fully up to date on what's going on in the industry with respect to the actual components, the building blocks of these technologies. With this, you can then build on top of that with all of the companies, with all of the innovative mechanics. We don't cover every company in this book. We never could. We talk about the technology, the components, the fundamentals, so that if you read this, you have all of the tools in your toolbox to be able to take this industry by storm and revolutionize your business or industry by understanding what's going on in blockchain, both with respect to the opportunities, but also with the opportunity to ignore the hype, to see through some of the jargon, and to really be an expert in the industry. So that is Blockchain Explained. I'm lucky to be an author alongside Herwig Konings and Peter Gaffney as my co-authors. Fortunately, Mark Powers, our former SEC attorney and advisor, who is also a university professor at the FIU Law School, gave us an amazing foreword to start the book. We also have a few unbelievable quotes from Anthony Basile from Coinbase. We have Anthony Mora from Provenance Blockchain Foundation, of course, and also Patrick Mira from Invenium, all giving us amazing quotes here on the back. So major shout out to everybody who supported us with respect to this book. We did hit the #1 bestseller in the business law category on Amazon, as well as hitting #2 in finance and banks and banking. So we certainly, I think, hit the categories we were looking to service, and it was great to see such a positive reception. We've gotten so many 5-star reviews for the book. I've sent so many copies to clients, friends, and family, and we really, really appreciate everybody that supported us along the way. If you want to get this book, you can get it on Amazon. You can get the Kindle version. You can get the paperback version like you have here, or there is a exclusive hardcover option as well if you want the full Monty there. And reach out to any of us with any questions you have. Thanks again for everybody for tuning in to the Tokenize This conference. And we are going to get ready for our next panel, which is going to be amazing. We have a whole slate of amazing things coming up this week.
Lost on the way here.
You got lost on the way here. But he's here. We're live and in person, and we're going to dive into the story of TokenizeThis, which is easily one of the leading, most pioneering companies in this industry. We're going to hear it from the horse's mouth. But before we get into the good stuff, Carlos, why don't you just tell everybody a little bit about your background, even before you got into digital assets and tokenization?
Well, thanks for having me first, and congratulations for the 5th anniversary. It's been a long journey together.
You guys are coming up on 6.
We'll talk about this later. So my background is I'm originally from Barcelona, from Spain. I studied computer science, so I'm a technical person at heart, even though I don't code anymore, unfortunately. But I think I'm technical enough to understand the engineers and be able to discuss with them. I studied computer science in Barcelona. Then I did a master and a PhD in Japan, of all places. I got on a scholarship to go there. I studied in a place called the Tokyo Institute of Technology. And when I finished my PhD and my postdoc, then is when I started my career. Initially in something interestingly, it was called digital assets, but had nothing to do with this industry. It was referring to the assets that were digitized on the internet at that time, which were images, fonts, and things like that. This is the beginning of the internet 20 years ago. So we basically go into the space with this. I joined a startup, was one of the first employees, started as their CTO, and then the startup in Japan expanded in the US through acquisitions, and I moved there, worked in the West Coast for a period of time. And we went from like doing an IPO to completely crash and got delisted. So I've been through bear markets before in a different context, and it's pretty painful. But if you survive, then you emerge as a stronger company. And that's what happened there. And then after that, I completely shifted gears, and I was recruited by a company called Telefónica, which is originally from Spain. It's one of the largest telecommunications company in the world, to basically look at not the actual core telco business, but the digital layer that people were expecting that was going to happen on top of the telco networks. And that was pre-iPhone. And actually, I was lucky enough that I joined the teams with a small group to start looking at digital services beyond connectivity, like the year before the iPhone launch. And obviously the iPhone and then Android was like a game changer for the telco industry, because people suddenly started using applications on their phone, right? So the phones turned into mini computers, and that completely revolutionized the industry. Unfortunately, telcos never managed to capture any of that value. That value moved into a different layer and different part of the industry. And after working Telefonica for a few years, I moved to Dubai to work for another telco there. I was, pretty bored of the industry, and I thought, like, what are interesting things happening? And fintech at that time was kind of starting as an industry, and I thought it was very innovative, and also that the banks were also more active there. And when I was looking at, ideas on the fintech space, this is when I stumbled upon blockchain. This was around 2016, when Ethereum had just launched, and there were the frenziness of all the ICOs, and this is when we thought, well, this is a pretty cool way to raise money from individuals and to provide liquidity, which is something that doesn't exist in private capital markets. So why not doing it in a regulated way? And that led to the creation of TokenizeThis.
Wow. That is an incredible story. If I'm picking that up right, you actually were in digital assets Web 2. Before you got into digital assets Web 3. It makes a lot of sense.
I actually had a software that the industry term was digital asset management. Where the software was managing like basically pictures that were, have copyrights and fonts. And, those are where the digital assets people use before. It still exists. The company actually still exists.
It reminds me of kind of funny when the original topic of security tokens came out. There was the physical bank security
tokens.
The tokens,
so a lot of people, secure.
Exactly. Confused.
By the way, we still use them when we connect to Coinbase Prime and things like that. So that still exists as well.
Lots of tokens out there, lots of digital assets, but the only ones that matter we're talking about today are, of course, asset-backed, securities-backed. So what led to that light bulb moment? How did you get into digital assets from there that sort of said, you know what, it's time to take the leap, and said, this is the future?
I think it was just to be, not to pretend I'm a genius that I saw the future. It was a bit accidentally. So when ICOs were exploding, I started participating in ICOs to try to understand better how, blockchain was working. And it was very clear that, there was, this was a very simple way to issue something that obviously now in retrospect, people understand that there were securities, but back then we're not being treated as that, but issue something that represents something of, let's say, value or economic exposure in an underlying project, and at the same time being able to trade it in a very efficient way, right? That's what a blockchain at the end of the day is, right? This is how you move value around in an efficient way. So at that time, then there was a lot of people, I remember David Sachs being one of the very prominent ones, and there were companies that were just starting, like Polymath and Blockchain Capital did their ICO, and we like that looked like something very valuable if you can actually do that with real, what people now refer to as real world assets, which are for the most part securities, and then try to digitize that process to make it more efficient. So, and that then I started learning about it. I had no idea. My background is not financial services. I was very naive, thinking this is more of a technology problem, when it turns out there's a huge regulatory component, which I'm pretty good at now, but not at that time. But I figure out, like, look, everything is solvable. So, if there are regulations, we could probably code them, and this platform looks like a more efficient way of doing it than traditional technology. So that's how we embarked into the project, without understanding how complex and how difficult it was going to be.
Yeah, I think that's probably the case for many, but I think you're being a little humble in the sense that, yes, you didn't have a finance background per se, but it required that technical background, and marrying the concept of raising capital. You already saw, you had experience with startups in the past of seeing, okay, there's absolutely a use case here, and definitely 2018 was a different animal than it is today. You want to talk a little bit about how everything's shifted?
I think look, so there's a bit of a deja vu moment in the industry between 2018 and 2023. It's been 5 years in between. So 2018, this is when you guys kind of fully launched, and when we also launched, and there were so many companies in the space. It was Harvard, it was Polymath, tokens of OFN, many of them don't exist anymore, and there was like a lot of appetite for doing productive things with blockchain. And there's also a lot of like pilots with banks, and this company about digital assets that was going to digitize exchanges, and there was a lot of that stuff happening in the industry, and unfortunately it didn't happen for a variety of reasons. I think first, companies like us or many others, they probably didn't understand the complexity of this topic, because it's not just a technology problem, but it's a regulatory problem, and there was a lot of regulatory uncertainty. Is this legal? Can I actually use the token as the representation of the securities or not? Do I need to keep a copy of chain? Or, if I trade it, how do I settle a trade on chain? Like, there's so many things that, people didn't know how it worked, and there was no clear regulatory guidance. Today, there is. The second is that companies didn't have licenses to operate, right? So all the large regulated entities will not touch unregulated companies in this space, because there is a lot of risk to do that. Now it's a very different story. Like, there's many companies now, like us, with a transfer agent, with a broker dealer, with an ATS, that can, legally operate and approach any company in the space and give them comfort that this is legal. And then on the other hand, the other thing that happened is that the crypto industry itself just went off a completely different path, which is in my opinion, the easy path of let's try to bypass regulations and play regulatory arbitrage, issue things that don't look like securities, even though they kind of like securities, but pretend they're not. People continue doing ICOs in spite of the SEC guidance that they were illegal. And then when that ended up, they come up with the concept of the governance tokens, and then after that, the NFTs, and you name it. Like, there was one thing after another. And I think 2022, when everything came, crashing down, and lots of companies went out of business, a lot of fraud was exposed in the industry. The regulators started becoming more active in terms of enforcement actions, which I know people don't like in crypto, but in retrospective, if they had done more of it, maybe we wouldn't be here. And then now in 2023, I think a lot of the crypto people have realized that you have to use blockchain to do productive stuff, right? You have to take assets that actually mean something and have a value, and make them more productive and more effective by putting them on chain. And I think that's exactly the same vision that we had 5 years ago that now is kind of manifesting. So,
well, let's talk about that vision and how you got there. You have acknowledged that you were not expecting, and I don't think anyone could have expected the number of challenges and requirements that you go through, but you were many times the first to get a transfer agent, the first to do many tokenization use cases. You were always on the ball. Why was that? It was just because you were getting great investors. Like, I know you raised money from MUFG and Morgan Stanley and many other, blockchain capital you mentioned. What sort of you think made Securitize that become sort of that go-to icon that really represents a lot of the industry today?
That's a good question. So I don't know. I think that we've been, without sounding pretentious, I think we've been good at executing when we fix on doing something. We've also been good at not trying to do too many things and go one by one. And, at the beginning, when everybody was trying to become exchanges and broker dealers, we started with a very basic, concept of transfer agent. That was something that people in the industry were not aware of, that was going to play a big role here. And then we've always been very conscious about spending money and not overbuilding and overhiring, because that's what led to the disappearance of many companies in this space. I think as an entrepreneur, there's certain things I can control. Who do I partner with? Who do I hire? But there's one thing that is very hard to control, which is the timing of what you do, right? And timing has always been the biggest uncertainty in our industry. So I think the goal was, first, believe that it's going to happen, have investors that have shared the same belief. And second, be able to stay as long as it takes until that thing happened, right? And in terms of getting good investors, I think this is a consequence of that, right? Like, when they saw that we were executing, we have obviously been in other industries and in other parts of our career, myself and Jamie and other team members, with some degree of reputation and credibility, and that's led to have this very solid investor base that really believes in what we do, and that they also understand that we're very conscious about how we are spending their money, because it's their money at the end of the day, and always making progress in the industry. So,
well, before we move on from the ecosystem, just so that everybody really truly understands that many people got into the space just in the last 18 months or so alone. If you're picking up on this, that's right. Securitize started out as technology. They brought on a transfer agent license. They went through and, became a broker dealer through FINRA and many other, and now you bought an RIA recently as well. So to expand the ecosystem to tap into registered investment advisors, is there anything missing in the ecosystem now? Do you feel complete? What's your status?
no, look, I mean, there is a bunch of stuff that at the end of the day, if you think about like the other day, the CEO of Fidelity, she said something that really resonated very well with me because it's actually the name of our company. She said, tokenization is securitization on steroids. And that's what it is, right? That's why we call Securitize, because even though I don't have a financial services background, when I started looking at the process was like, well, if you're going to put assets on chain, you have to put them in a within some sort of legal framework, right? And that's what's called securitization in traditional capital markets, which is an extremely inefficient, cumbersome, and costly process. So if you can actually make that very efficient, then those assets then also add other features like liquidity, lending, etc. Then that you're transforming an industry. And that was always the vision, right? So to do that, there's a ton of things you need. You need somebody that can issue the securities and manage them and do investor onboarding. That's the role of a transfer agent. You also need a fund admin. We partner with a lot of fund admins because those are, for the most part, these are funds or SPVs that have NAV calculations and accounting and stuff like that. You also need tax reporting. People don't realize these tokens are regulated. And then people like us, we have to produce 1099s and all that stuff. Then you need places where people can purchase them. So these are like broker dealers. And then you need places where you can trade them. There are ATSs. And the part that has just starting now, but is still very emerging is, how do I actually use those assets as collateral for lending, right? So you can then provide liquidity in a different way, right? Like you can provide liquidity by selling it, you can provide liquidity by doing redemptions, or you can provide liquidity by borrowing against it. So there's still missing pieces in the ecosystem. So, and then the recent acquisition we did with OnRamp is something we started working with them. They're not an IRA, they're just an IRA enabling platform. So if you're a registered investor advisor and you want to purchase an asset, you can purchase from Securitize, but it has to show up in your reporting system, so your investor sees that those assets are being managed by you, so you also get commission. And there's a whole cumbersome process of how you enable an IRA to purchase an asset on behalf of an investor, which in this industry, both digital assets and digital asset securities was missing. That OnRamp basically cracked the code. So we started partnering with them. We really like the team. I think Eric and Aston and Joe, they're fantastic, and then decided to acquire them.
I think that makes a lot of sense. It sounds like you went from first creating the technology, validating it in as many possible use cases as you can, and now traditional finance is starting to see the opportunity, and you're offering the opportunity to partner in and really stick to the make as little disruption to adopting this as possible by plugging into the infrastructure like a technology tool like OnRamp. That makes a lot of sense. What is the most important, you think, for the industry in the next, year or so? Is it building a large user base of investors so that offerings can see demand? Is it the opposite? Is it continuing to find incredible clients that maybe you should highlight, like you've had, like KKR and Hamilton Lane and others, to really, continue to prove the institutional use case? What would you say is your priority at the moment that you think is going to have the most short-term effect when it comes to really, again, moving the industry forward?
So this business is a two-sided marketplace, right? So you need assets and you need investors. I think the asset side, I wouldn't say solved, but it's already there.
Right.
And as you mentioned, we've partnered with KKR, with Hamilton Lane, with many other small ones in the past, but those are like very marquee names. And I think we don't have a shortage of tier one large asset managers that want to work with us, but they want to see that the other side is there as well. And I think that part, investor adoption and more utility for tokenized assets as opposed to non-tokenized assets in a form of better liquidity, better redemption, better lending, etc. That's the part that, in my opinion, is less developed. And that's where we should put the focus there, all of us collectively as an industry. And this is why we're quite on ramp, because it's all about distribution and bringing more investors, etc. So I think that part to me is the part that, if you look at the two sides of the equation, that is less developed today. And then in terms of what else needs to happen in the industry, I can tell you that my main concern now is that with this narrative of real world assets, which by the way is a terrible name, but
agree.
at the same time, it signifies that, you know, a lot of crypto people think what was happening before in crypto was not real, right? It was imaginary internet money, things that are not
That's
real.
true.
So from that perspective, it's great saying, okay, now we're going to do real things instead of imaginary things on blockchain. That's great. But I see a lot of projects that are very non-compliant, and that scares me a lot, because the last thing we need is more fraud, more illegal activity happening, people misrepresenting what they do in terms of who they work with and saying, oh, I'm tokenizing BlackRock shares. No, you're not. You're just buying BlackRock shares from the open market and putting an SPV. That's not tokenizing BlackRock shares. You have to work with BlackRock to do that. So, you know, there's a lot of those things, a lot of crypto lending protocols for real world assets that are, you know, questionable whether they're, you know, legal or not. And I think that if that continue happening, it's going to scare both the real investors as well as the asset managers. So I think we as an industry, I think that if you look at crypto and, you know, the crypto industry themselves should have attempted to self-regulate a little bit better to avoid all the, you know, illegal stuff that happen. And I think in our industry as well, we should have that as well, and try to talk to each other and say, look, what you're doing, maybe it's not very compliant. Maybe you want to think about not doing it, or at least, because it's, you know, if it blows up, it's going to impact, you know, the industry. I don't know if you saw recently that there was one of these stable coins that is supposed to be backed by real world assets, that they were just like buying some really bad stuff, and then just they peg 50%, and there's a credit protocol that was just basically buying very, very bad loans. And, you know, there's no point in putting those things on chain. Those are bad assets to start with. So, those things can actually bring a negative perception to this part of the industry, which at the moment is in a good place, right? Because at least people see them as regulated versus unregulated, etc. So.
In another way of saying it, let's not hope the crypto RWA movement hijacks the overall transformation of finance, which is
correct,
what we're talking
because, you know, transformation of finance, we had this recently in a different context, a discussion about CeFi versus DeFi. And you know, for a while, I love of DeFi as a technology. I think that DeFi is not something, as of the way it is designed today, that no regulated entity is going to use. I mean, it's completely permissionless, completely anonymous. You don't know who your counterparty risk is. There's hacks all over the place in the protocols, and you know, a lot of stuff that scares the. So I think that the CeFi approach, with obviously blockchain underneath, and it's you know, companies like Anchorage or us, etc., they're going to be the ones that should be leading the pack, and we should just prevent that all those things that are not compliant spill into the space, and then try to leverage the technology. I think, you know, DeFi has built great technology. Maybe there's ways to apply it in a compliant way for real world assets and so productive stuff.
There could be a world where, you know, you take advantage of the licensure, the infrastructure, the network that you've created to take advantage of technology like an automated market maker, but not necessarily, you know, eliminating the concerns of permissionless, anybody can access it, what's backing it. You know, these are key things that as investors and participants, we need to know. It's funny that everyone enjoys the freedoms, if you will, of crypto, but then suddenly when you lose your keys or when you get scammed or whatever, and there's no recourse, everybody is suddenly changing their tune, right?
Not something that, well, you were liking it before. I think from the DeFi side, there's two things. Obviously, lending, which I think is super interesting, and it's easier to get it done in a compliant way. Automated market making, you know, I love it. I love that could be something, because obviously, as an ATS, we suffer the problem of, you know, listing long tail assets that are illiquid, and that potentially has an opportunity to solve the liquidity problem for long tail assets the way they're solving it for digital assets. But the way it's constructed today, I think it's going to be very, very complicated to make it compliant. Yeah, because there's too many things that happen there that just go against a ton of different regulations. So it require a major regulatory change for an ATS like us to be able to use Uniswap title protocol as market making. But lending is very promising.
Lending seems like we may soon see some features around on a securitized platform, which I absolutely agree with. It's this concept of leverage that will bring in more interest. It is a form of liquidity many people don't think about, and many people actually sometimes prefer, especially like you said, these are long tail assets. Not everybody wants to sell early. So there are other opportunities. I think that's great. Let's dive into a little liquidity a little bit more. We've talked about, how you're building an audience. You've got potentially some of these technologies that are a little too early. What about market makers? What are some of the other solutions that you guys are developing in order to, create a robust market?
This is very interesting because the way we built our trading facility was to try to leverage as much as possible blockchain and to leverage something called the 3-step settlement process that the SEC approved, where you basically have an order book where you have a buy and sell, and when there's a match, as an ATS, they will instruct the custodian of the cash and the custodian of the securities to swap and then settle instantly, right? That doesn't happen in real markets. When you go to Robinhood and you purchase Apple shares, you're not really owning them until like 2 days after. Even though Robinhood and all this, they do a very good job on the UI to pretend that you own that. But, you saw what happened with GameStop and other companies where there is this mismatch between the settlement periods and there is a huge, variation in price, right? So we settle instant. Now, what happens is that goes against what a market maker does, because a market maker, what they do is they intercept orders. if you settle instantly, there is a hard so we're like trying to figure out how to combine the best of blockchain with market making, because obviously there's market makers that work for companies, like OTC markets, etc. So that's there. But I think that, if I think of in terms of priorities, you have our transfer agent and tokenization business. That's what's working today. Put assets there. Then you have to get the investor distribution, as much more investors participating, much more assets in the hands of investors. And then the third will be the liquidity mechanisms, which whether they're trading, which is one of them, whether it's redemptions in a more efficient way, which is another very interesting thing you can do on chain. And the third one is lending. So we kind of see the world in like these three horizons. So
in 2024 and beyond, we it's safe to say the technology is obviously there. You've done a terrific job. How many investors are on the platform now? I think
so we have accounts. These are not like full investors that have actually invested anything, around 525,000. So that's a lot. We've talked with KYC, probably like 150,000 of those, and then the ones that hold securities around 50,000.
And I imagine
that's it without counting our traditional transfer agent business, which is not digitized, so I don't count it there.
But it has made you technically a top 10 largest transfer agent.
Correct. When we add the both things in terms of investors that we manage, we're pretty large.
We hope there's an inevitable migration.
Well, that's the plan, right?
So no, and that's what I think we're getting at, folks, is we're in that stage of companies like Securitize are doing an incredible job of providing the technology and enabling issuers to distribute and bring that audience in one place. And then the third factor will be that liquidity. There's a lot of people who look at this technology and they jump to that last part. But these last 5-6 years that have been happening have been because first we needed to make sure the technology is compliant and it works and institutions can rely on it just as much as a small entrepreneur. And now we have the proof in the pudding. People are raising capital. People are taking advantage of atomic swaps so that they can buy into instant settlement. That's something we actually took advantage of for our very own crowdfunding.
You guys were very pioneers
with you guys on that. So there's all these different new ease of access to investing that tokenization is bringing, that once people actually hold the assets, they're naturally going to start to eventually seek out, of course, potentially leverage, potentially, some other kind of liquidity solution that might be, something that you guys are obviously working on in partnerships. Is there any companies or anyone you'd like to highlight as well within your ecosystem that you feel are, a critical part to this?
So as I mentioned, we partner with a lot of fan admins. So we partner with Medium, we partner with Stonegate. So I think that's an integral part of what we do for the tokenized funds that we have. So that's great, and that's another industry that probably requires digitization. Of course, the asset managers for us, they're not just partners; they're our customers, but they're great. So KKR was a very pioneer in that respect because it's a very well reputed brand that was the first one that did it. But and now we have Inton Lane. We have a very, very close partnership. We've launched already 3 different funds in 3 different verticals, because at the beginning what we want to do is to have a variety of assets to see what resonates better with investors. So we did an equity opportunities fund, a credit fund that's doing very well. And now we just recently launched secondaries, which is a very interesting space, because if you think about the craziness with private equity and VC the last few years, there's a lot of people that have LP positions that they want to sell. So people buying on secondaries at a discount are going to probably have better returns. So
a great use case.
So that's a very good use case. So and then we have others in the pipeline coming that hopefully we'll be able to announce soon.
Nothing he can tease us with yet, but obviously we'll make sure we get the word out once you do. I have no doubt there's some incredible partnerships behind the scenes that are happening just based on your track record alone. But you can't announce anything. Is there any advice or any, predictions you'd like to leave our audience with now that we got the last couple of minutes for anyone that's going into tokenization, either as an investor or a potential issuer?
I think we've seen so far the size of the tokenized assets have been relatively small, 10, 20, 50, 100 million. I think now Franklin Templeton has one that has 150, but few investors. But I think that next year we're going to see the first $1 billion tokenized fund. And I'm pretty sure about it. And I think that's going to kind of like signal everybody out there that this is a real thing. Because once there's a $1 billion tokenized fund with interesting features that the traditional fund doesn't have, and then that's when people are going to realize, well, tokenized funds are actually better than non-tokenized funds because digitization helps you provide productivity and more features and other characteristics to the underlying fund. So to me, that is when I think is going to be the inflection point in the industry. So I'm pretty, coming back here at some point in the next few months and tell you about it.
I think that'll be the plan. I mean, the bigger these assets get, of course, that means the more potential interest and demand and shareholder potential.
Correct. And all these other features like liquidity, lending.
Exactly.
When the asset is small, naturally it's constrained, right? So look, if you have a $10 million asset that has 20 investors, it's never going to be very liquid. It doesn't matter how good the technology to provide liquidity is.
And to say it's still better than having no liquidity.
That's true. That's true. People don't realize about it that some degree of liquidity is always better than zero liquidity. And liquidity is not black and white, by the way, it's a continuum, right? So, but I think the bigger the assets are, the more obviously investors will attract to the space, and then the more cross-pollination will be with other smaller assets. So.
Well, Carlos, it's truly a pleasure for me to be able to say that I've known you since the beginning.
Yes, we met very, very early.
Very
early.
That's right. But here we are today, and I'd still like to think we're just getting started.
I think so. Look, I mean, you've probably seen this narrative saying every new innovation gets adopted faster. This is not music streaming, man. We're digitizing finance, right? So, so it's going to take a bit longer, and it's going to be more complicated because the consequences of getting it wrong are pretty. I don't know
about you, but I'd like to keep my money and make sure no one goes
so
to
this
jail.
is the thing I understand, and that's why crypto is having so much tension with regulators, because if something goes wrong there, let's say in the music streaming industry, you lose the song, right? But here you lose your savings, and there's so many people that lost billions of dollars through all the debacles that happened last year. So and I think that's going to make it go slower than we expect, but is unavoidable, right? Because all industries get digitized. So there's no reason why this industry is not going to get digitized. So.
And it's great because it's in so many different use cases: the alternatives, private markets, the real estate, the credit, even the public markets. They're all taking advantage of it in a different way. And it's going to change the way banks today, folks, they still have errors. We saw also on Wall Street with GameStop. This will go away thanks to tokenization. Securitize, one of the leading companies making that happen. Keep up the amazing work, Carlos. Thank you for joining us.
Thanks, and thanks again for the 5th anniversary.
Appreciate it.
Yes, wait,
A little bit about the ecosystem that they've built, but now we're finally going to get into the meat of it, if you will. We, as a firm, Security Token Advisors, spend a lot of time not only helping our clients tokenize, but we also do a lot of education. Try to do a lot of research for folks in order to get them more comfortable and ready to actually move forward with the tokenization. So I have the great pleasure of being joined again by Peter Gaffney, our head of research and institutional at the firm. And we're going to go into a bit of a deep dive, aren't we?
Yes, we are. We're going to look at everything.
Let's do it. Well, I think the best way I think we can break this down is we have the traditional model, which is, you want to do a security token. I have an asset, I want to raise capital for it, or I want to eventually get it liquid. And you need to go through a very traditional model, but you're adding that layer of tokenization. And of course, by adding that layer, it changes everything below it. But I think we can start there to walk people through how you can go through the tokenization process. And then from there, we can go into some more use cases beyond just raising capital for tokenization. That sound good to you?
Yeah, definitely.
Well, I think we break it down most of the time with our clients in 4 specific phases. The first one, arguably the most important, is of course planning and structuring. The purpose of this we're going to get into is really making sure we've got the whole architecture, the whole blueprint down, so that when it comes to actually going into the second phase of identifying all the different vendors you're going to need to work with, it makes it much easier to have those conversations. You know exactly what you're looking for, and you'll move a lot quicker. Naturally, once you've selected those partners, you can then move forward with your actual offering to raise money. This is, referred to as distribution, right? We are distributing our product to the hands of investors. And in order to do that, you typically rely on marketing as well as some other models in the industry that many people use traditionally, as well as for tokenization. And then last but not least, what is the less common model is then, of course, going ahead and listing that once you've raised your capital. Many times there's even a period of time, a restricted period where there is no activity whatsoever, but eventually you do want to take advantage of that liquidity component to be able to take advantage of using that token in different capacities. So let's dive right into it with phase 1. Phase 1, we break down into 5 sections. The first is, again, arguably the most important, making sure you figure out the right legal structure, identifying the right lawyers to work with you on this. You can work with firms like us, security token advisors, as well as take advantage of many resources that are already out there to go ahead and start getting a good idea of what that legal structure can look like. You do not need to go to law school to figure that one out. In fact, we're going to have a great session with Robin Sosno, a leading attorney in the space, just after this to go over exactly that. But that's not the same as the investor onboarding compliance. These are the different requirements and rules you're going to need in order to bring on the actual investor. KYC checks, possible accreditation, and other things. Then that's different from the actual investor subscription, right? This is where they're actually looking at the deal. They may be looking at legal documents that they're going to sign digitally. They may be looking at certain materials that you're associating to the offering for them to consider before they go ahead and actually make that investment, which is, of course, another component to it, right? Bringing in potentially payments via a bank or via crypto. Then you've got the distribution systems I mentioned earlier. You can already start thinking about now, how are you going to go ahead and actually market this and get this offering into the hands of investors? And then we've got blockchain architecture, the coup de grace of the whole thing. Of course, everybody needs to have some kind of blockchain component to a tokenization. So how do you go ahead and figure out what's the right blockchain? We also have a great panel on that later today, but we're going to try to give you a little bit of a primer. So Peter, let's talk a little bit about this legal checklist. What's the typical things you're going to see as a client, or as a client going to see going through this process?
Yeah, I think the most common, I think a lot of clients come in with a pretty solid vision of what they want. And really, sometimes they back themselves into a certain vision and then try to find one partner thinking that'll be the end all be all. And it's really just not the case in a lot of times. But looking at it from the legal side and kind of, I think a lot of them would come in and say, listen, we're an offshore company. We want to establish an entity in the US. We want to raise from US investors, or even vice versa. Maybe they are based in the US, they have deep ties internationally, and they're saying, US real estate or US fixed income or certain, different industries are attractive to other investors globally. And so they'll say, how can we actually raise capital from people in my hometown, or from people in my home country, or from some of their family networks, whether it's a family office, an individual, a management firm, a corporation on the low end potentially as well.
So that's kind of where they would come in and really bring that initial vision, at least, kind of from what we see.
Yeah, I think that's a great way to put it. We kind of want to work back from 5 components, which is 1, the jurisdictions. Where are your investors coming from? That's going to have an impact on the legal structure. One of those very legal impacts is the filings, right? What are you going to end up needing to file based on the jurisdictions, and whether you're actually staying as a private company or going public? The investment documents themselves, they're unique to each deal. So having an understanding of what your vision is going to be very important for an attorney to identify what are the risk factors and other concerns that they need to write into the legal language of the documents that are typically a standard set of subscription documents to invest. And then the post-issuance financial services, if you already know you're going to use a marketplace, a broker-dealer, collateral services, or anything else, even utility functions like we talk about in the last, all of that potentially is going to relate back to the legal structure to make sure that it is set up the right way to allow for that functionality, and very much so ease of use. Traditional raises, they tend to, for example, restrict investors from even being able to transfer or sell their shares from the investment, whereas this is the opposite. We want to pre-enable the investors to be able to transfer, unrestrict that capability, and that's just one of the many fine point situations where you're gonna run into that. So that's why we always want to make sure that our clients find the right attorneys and work with the right advisors to make sure that they prepare the right language in the legal structure, enabling it very easy from there, usually saving a lot of costs with the attorney themselves when you want to go ahead and actually prepare and move forward with all of this, right?
Right. And always important to have that bridge between private placement, typical securities offering, and the actual use of blockchain. Because at the end of the day, that's really the difference in any of the filings. It's just really, how are you using blockchain? How are things designated? How are these securities transferring? To Herwig's point, eventually, if you want language for them to transfer on an ATS, or if you're overseas on a digital securities exchange, a multilateral trading facility, whatever, that's something that usually gets baked in pretty early on as well. So again, and kind of to my comment before, a lot of issuers come in with a pretty rigid, strong vision. So, making sure all those little pieces are kind of taken care of sooner rather than later is really the name of the game here.
Yes, indeed. And that gets us on to the next step, which, not necessarily your legal counsel will be helping you with. This might come towards your technology strategy in terms of how am I going to onboard these investors? There is typically a requirement for KYC and AML. Folks, the deeper you go into finance, the more this becomes important. And the idea that you could run an AML check on your audience of investors on a daily basis to make sure that if Pete does something wrong tomorrow, I can get rid of him. I doubt that's going to happen. But you get the point. This is the idea of what a new future looks like. It's a lot safer because we're implementing this new digital onboarding. We talked a little bit about it on our compliance panel on day 1, this idea of investor passporting. That's what's going on here as well. Many tools, like we just spoke with Carlos, he mentioned TokenizeThis. That is one of those investor passports that, based on it being supported by other locations, you can then send over your compliance information. Really cool. A big thing is, of course, being able to fool these systems. So now today, many KYC providers, they actually enable you to go via phone and check to make sure that the person looks like who they say they are and they're actually moving and it's real. It's not just a picture. And naturally, a lot of this can be embedded into the user experience. As I said earlier, this can be sometimes default in a technology provider that's including the investor onboarding component, or it can be separate. Again, based on your technology strategy, you may be building something custom, and so you need custom providers for that piece. But the point is that this piece will allow you to onboard, if you wanted to, 10,000 investors in a day from a technical perspective without any human interaction. Now, I say that because naturally you'd need some really good QA and instructions on the website so that it's super easy and seamless for investors to do that. But if that is the case, there is nothing preventing you other than, potentially some, depending on the legal structure, that you could then onboard 10,000 investors, again, without having 1,000 people on phone calls. Now, of course, a human touch always helps facilitate that and optimize that chance. But the point is technology makes that possible. Peter, of course, we got through the kind of boring stuff, the legal, the compliance. We're talking now about the real user experience, the thing that matters, the investor subscription. How do we plan for this? What should clients usually look out for?
Well, the interesting piece is it really depends on the level of the client. If they're more, if they're like a lower level or, kind of lower market investment fund, then they have a bit more leeway. As obviously you get up into the more institutional side, you're going to be a bit, carriaged as to what you can really do. But really the name of the game is to reduce touch points and just to reduce that interaction, exactly what Harvey said in the previous slide, from the actual onboarding side at least. And so when investors are coming in, and this isn't something new, or well, it's newer, this isn't something limited to tokenization, but rather just having all these, digital portals for investment management, for investor onboarding, for investors themselves to interact with the issuers, deal room and documents and whatever. It's become more common now, even for investors, to have 20 different deal rooms to log into, 20 different issuers, let's say. So the real goal is to, how do we aggregate all of these into just one kind of host portal, or at least into a few rather than a dozen? And easier said than done. Again, the whole theme of the last couple of days is seeing how things are becoming more interoperable, how firms are connecting to each other in more efficient and effective manners. Later we'll talk about some use cases that are showing this already. But looking at it purely from this standpoint, I mean, everything is going to be, uploaded right here to the deal room online. It's an important part also from the issuer standpoint. What I want to touch upon is the actual experience. Sometimes you, as the issuer, if I'm a real estate manager, I want to bring on 100 different investors. I want it to be branded PGAF Realty or something like that, quick example. And I want everyone to see that it's my site. They're coming in that maybe I'm white labeling technology and licensing in the back end from one of the various players we work with. But everything as the investor, you're coming straight to me, versus if you want maybe just a one-off issuance, I can work with a company like TokenizeThis, more in the mind from the previous panel, anything like that. And investors will interact directly with that platform rather than with me in that case.
Yeah. And I think a great thing to highlight is, just like with the legal, it's all about kind of working backwards from that vision. Usually a lot of the time you have an idea of, oh, I want this hosted on my website this way, or I want to build it my way, or I'm happy to host it somewhere else where there's already credibility built into it and they already have a nice standardized system. Yeah, and it boils down to like what you said. This is the user experience. This is where I'm interacting with the deal room to see, to get convinced to be able to invest. And then I'm signing, I'm wiring or paying for my investment somehow. This can typically be and traditionally is a 6 weeks to several month process. And now again, digitization enables this to be sped up, to be easier, to give the user control to make the decision to invest without having to talk to anybody if they want. This is all going to be important to how you want to bring on investors. You can actually figure out what that investor subscription experience will look like. And once you have an idea of that, that naturally means you now need to figure out how are you going to get investors to that investor subscription stage. And naturally, you want to think about your in-house marketing. This is, of course, any company strategy wanting to do a financing event or talking about raising money in the old school way. It typically meant the entrepreneur or whoever is running the fundraising process to evaluate and come up with a similar deal room, but instead of it being a very public or open experience, it was a very closed experience. They think about all these different investor lists or groups that they can go after and pitch individuals. Now that's different. With tokenization, of course, we can leverage that digitization component, the fact that everything is seamless and accessible online. That means we can now tap into more scalable solutions for marketing, which is, literally coming down to potentially ad spend. If you leverage certain exemptions in the United States or across the globe, you can actually go ahead and do a radio ad, do a film ad, do a Facebook ad to help, try to reach an investor and say, hey, come check out my deal. PR and media is another, of course, big angle to that about doing pending filing and all that good stuff. And then there is the new evolution of those old school ways. So instead of having to go to an investment bank and them going and calling up their Rolodex, if you want to stay old school, they're now leveraging an audience of email addresses and accounts that they've onboarded and are able to digitally reach and enable them, of course, to invest through those brokerage solutions, which allows you to tap into a third-party distribution system. But not all third-party platforms are brokerage platforms. They're not necessarily broker dealers. There are crowdfunding portals. There are other platforms that the way that they are structured enable you to tap into the audience there without necessarily having to enter into a broker relationship. And then last but not least, of course, as we again just heard from TokenizeThis for on-ramp, they access hundreds, maybe even thousands of RIAs in order to basically allow you to distribute to investment advisors who have their own book of clients who now through these channels can present them new tokenized opportunities to invest in. And of course, these are all very different marketing strategies, right?
And those last two pieces there, third party, these last three, brokerage, third-party platforms, RIAs, and traditional routes is really where we need to kind of hammer home. It's still, as we heard from Eitan Butler and Richard Luptig, Castle Dalmore Group and Castle Placement, respectively, there's still a lot of room to run right now on the the private placement side, raising from retail and kind of raising direct on your platform, which is great. And that's also the in-house marketing and the kind of traditional marketing avenues, more like an e-commerce branding, if you guys remember that statement. But even looking at it to unlock, bigger capital pools, I think a lot of the firms, the RIAs, it's just a challenge to figure out how they can really hold it. A lot of this comes and backs up to the custodian side. So as that layer, that kind of base layer improves and gets a bit more connected, we see BNY Mellon yesterday, we see, Trident Trust on the custodial side, we see, or fund admin rather, we see some of these players come involved. As that builds and fortifies, that's where you'll see more traditional routes like RIAs, wealth management, capital, private banks. Already seeing that with Citi, but that will unlock tremendous pools of capital, even for newer, higher level investors relative to what this industry is used to, but lower level relative to existing capital markets. And that's probably the sweet spot that I'm kind of targeting mentally. So it's all, in play. It's not off the table. It's just a matter of getting to that point of integration.
In other words, we're really talking about a merging of traditional ways of raising capital with this new tokenized world. And then eventually we'll have the whole enchilada to be able to tap into in a much easier and cost-effective way. Now, last but not least, in order to finish off this, again, what sometimes can be a very long planning and structuring phase is potentially clients understand new situations, they compromise or adjust their original vision. And surprisingly or not surprisingly, maybe most of the time, the client doesn't necessarily have a specific idea of which blockchain they want to use. In some cases they do, maybe they have an affinity or they know somebody there and they've been, decided to go forward just for that reason. But otherwise, it usually comes down to a lot of different concerns, which is the level of smart contracts that are needed. For those of you who are very new to this, you need a smart contract for each function that you're looking to leverage, for these transfers, for these staking, for these compliance checks, for feeding in certain data. Every little bit of activity that interacts with the blockchain needs a smart contract to power it. Now, the more smart contracts you have, obviously, the bigger and more complex your token gets. And in many other cases, there are standardized systems, standardized smart contracts out there that you can just tap into, built into technology, or standalone if you want to kind of bring it in yourself. But at the end of the day, it doesn't really matter how it's written. It's just how do you want to use a smart contract? So that's very important. The next big question is not everything needs to go on chain. So you need to question yourself whether or not you actually want this information living on a blockchain,
Locked in.
locked in, which could be for security purposes, for transparency and information purposes, corporate purposes, but also cost purposes. The more you're adding on to it, the more costly things are going to get. And so you really want to evaluate what needs to be versus what can still be tied into it from a third-party data source that's not on chain, for example. And of course, how you evaluate a blockchain, we're going to get into a little bit later. But when I look at them on behalf of our clients, I usually bucket it into 4 categories. I say, okay, first, let's look at it from a developer community, right? Ethereum has been around one of the longest to really even pioneer smart contracts. They arguably have the largest community of developers building applications on it, but you've got other chains like Avalanche and Stellar and Hyperledger and Polygon that we heard about as well, and Base. These are enabling new tools, new features that are attracting more developers there. And so, might we see a migration? You're almost betting on the infrastructure. They all use different programming languages. That has an impact, of course, to the developer community. Then there is the classic age-old cost and efficiency, right? How much is this going to cost me every time I want to do a transaction on the blockchain? Does this become something that is manageable and justified if we were to go through with tokenization? There's incentives out there, folks. There are grants in many cases from the different foundations to incentivize folks to go ahead and leverage that chain for whatever project, and in this case, obviously focused on tokenization. You even have VCs out there that specifically back projects that are using or leveraging a specific chain. Even developer support varies depending on chain to chain. So if you can get more resources, which includes also media and PR as incentives to work with that chain, that might, of course, have an impact on your decision. And last but not least, it's the investor community that ultimately wraps around this. You may not be saying, okay, well, there are developers there. I'm happy with that. They're fine. It's not the biggest. It's great, but I'm going to go with this community because they have a super engaged investor community, users behind it, so that when I tokenize on this chain, I know I'm going to tap into that community. They're likely want to also invest in my project because it shares the same chain. Those would be the kind of macro buckets that I would say. Anything you want to add to that?
Yeah, I would say looking at it, again, it comes back to the client goals as well. Someone who just wants to maybe roll the dice and raise capital in any way, shape, or form to add to their existing operations, say a private equity fund, private credit fund, a few $100 million. If I could get even 20 to 30 extra million, I'm cool taking that chance. The chain is less important, right? It really comes down to the capital raise strategy in that case. But for someone like we're seeing in the money market side, especially the treasury side, if you really want to eventually interact with DeFi, with automated market makers or kind of lending and staking services, protocols, whatever, the ecosystem is what you're going to want to look at. Like Ethereum, arguably, maybe inarguably, has the most robust DeFi ecosystem to date. And so ETH or its layer 2 chains, like even Polygon we saw yesterday, or even EVM compatible chains like Base, like Avalanche we talked about. That's where you start to evaluate, okay, where's the future roadmap looking? To Herwig's point, where's the investor community? And if I want to start rotating, crypto holders into my tokenized securities and tokenized assets, that's what you're also kind of looking at. Yeah. And so the depth and the breadth and the depth of the ecosystem is going to play a larger role than someone just coming in using it as a new capital raise source.
Oh, absolutely. I think that's really well put. Now that we've gotten through, we only have an hour today. So naturally, there's still a whole lot more behind these slides, but, we are a business. So please come apply at our website, securitytokenadvisors.com, if you're looking for our help. But in the meantime, hopefully this gets you started on your own. There is definitely even more providers to the ecosystem that you may run into depending on the structure of your offering. But the idea is now that phase 1 is complete, it's going to be pretty easy for us to go try to find the right lawyers, understand what the compliance needs are. Do we need a transfer agent? Do we need certain technologies? Of course, picking a blockchain will be much easier, knowing how the smart contracts need to be used, how custody plays a role into all of that. your marketing mix, tying into everything, the back office management of the investors and the administration is another whole wheelhouse that you could actually bucket into its own technology, often married with the deal room and investor subscriptions, but they can be standalone. And naturally, as we've been discussing, you might have brokerage partners of all kinds, marketplace partners, distribution partners, et cetera. They may come into the equation. So, that all tends to tie into each other in one form or another. So again, we put so much emphasis on planning and structuring before you start to engage with this ecosystem. And again, there's probably even way more, but as we like to tell our clients, this is a new industry. There are a lot of options. You may have certain preferences in terms of how you evaluate your partners, but I think we can usually put it down into 5 buckets when you go ahead and start doing a comparison within the industry. First is naturally the cost. This is usually a big driver for a lot of folks. Some want to maybe have a very strong legal setup, and they're happy to work with a top 100 law firm, whereas others would like the necessities on the legal side, someone who knows what they're doing, but they're more boutique and therefore offer a lower budget. The business model by many of the technology providers differs from SaaS to assets under management basis points and a variety of other fees and structures. You're obviously also going to want to evaluate their experience, their actual clients that they've worked with, to understand, okay, they are working with either similar companies that you might want to be associated with or similar to what you're doing, or they at least have that track record that suggests, okay, this is somebody that I know if they've worked with them, those people have probably done the due diligence to make sure that this provider is the right company to be working with, which leads into that partnerships in the ecosystem. You saw in the conversation before this with Carlos, how I kind of drilled him about the ecosystem that he built, the capabilities. I asked him, who are your key partners that you work with? Because for institutions, it might come down to even one specific fund admin that is supported by a specific provider, and therefore everything can hum. That's just one, again, unique example. And then last but not least is the reverse of client experience is you should actually reach out to the clients that they just told you about, and you should review with them and say, how was your experience? Can you tell me about your thoughts on that company that you worked with for your tokenization efforts, so you can fact check exactly what everybody is touting? Anything you'd like to add to this, Peter?
No, just the connectivity of the ecosystem. Maybe you want a one-stop shop. Maybe you need to, or you want to piece things together based on where you see the ecosystem developing. So there's a whole, kind of debate or just 2 schools of thinking between kind of a closed network. You show up, boom, they'll take care of everything, run the ball down the whole field. Others is more of an open source, open ecosystem approach between, primary issuance and transfer agent functionality to secondary trading to third parties in the middle.
Yeah, no, I think that goes back to this recurring theme of, as long as you have your vision down, it'll be a lot easier, especially if you work with someone like us to help you figure out exactly who the right firms that you're going to need to work with, because you absolutely cannot do it on your own. Phase 3, of course, now that we've gotten our partners down, we know exactly what we're tokenizing and how we're doing it. It actually needs to get funded. And so, of course, we will be doing a full breakdown. Actually, we increased the length of the blockchain panel. So this will actually be at 2:30 today, but we will be diving into the exact details of distribution and marketing, because again, it is so important and deserves its own, topic. However, you should expect going into this phase, just like any other fundraising event, right, that this is going to usually take around 3 to 6 months for most projects that experience that timeline. Usually they have some kind of answer from the market within that 6-month period. But we've already seen in the case of realty, as we heard from Remy earlier yesterday or on day one, they've had properties literally sell out in minutes. We've seen that also in some other situations outside of realty. And you can also structure it so that it's open-ended. This could be a continuously growing token model, or in many cases, it is not, dependent on a specific timing period. And so you're able to, take a longer time and even sometimes take years to eventually find that capital. And so you need to really consider, are you going to do a diversified distribution strategy? Do you want to try to tap into as many different channels as possible? In other situations, some folks like to put all eggs in one basket. This can be dependent on your budget. You may be limited to only selecting one solution to be able to move forward with. And you really want to evaluate all that from a paid model of, okay, I'm going to pay up front and I'm going to hope I'm going to get a return from investors. There's performance. So you know that you're only paying for when money is actually brought in. And then of course you do want to consider what you can do grassroots, that organic reach that you can get from your customers, from what you can do without having to go to pay to play type options. And we need to remind everybody, of course, and if you didn't catch it on the title slide, none of this is investment or legal advice or really anything like that. But we want you to know, of course, there is no solution that magically is going to guarantee you suddenly your fundraise. It doesn't matter. A bad asset will remain a bad investment. And tokenization makes it easier for investors to access. It may even lower the risk for them, but ultimately, it's not going to change the fact of whether they like the investment opportunity or not, right? Anything to share here? Well, I'm going to break it over to you again. This is such a big topic. We even have a special guest, Centrifuge, who will be bringing in their take. But this liquidity and financial services is a big angle that you need to consider, right?
Yeah, definitely. And this is the one, this was always the holy grail, I feel, of the industry, saying you can trade real estate assets the same way you trade a blue chip stock. And it's taken time to develop. And, we touched upon that. We saw some of the secondary trading activity yesterday. But really the ultimate goal is, any new liquidity is probably better than no liquidity. And even when you look at major funds on Blackstone's side, on Carlyle's side, and the redemptions that they offer, we're already seeing companies like that making use of tokenization to improve that process. So Hamilton Lane, for example, has, I think, 5 or 6 funds total tokenized right now across, I think 3 or 4 different platforms, different goals with each one. But, eventually them and companies like them will probably end up using the technology that we're seeing on the transfer side, whether it's a bulletin board system matching orders or a bulletin board system supporting certain permissioned parties. Instead of them having to boost their back office or reconciling any redemptions or swaps between parties or between themselves and investors, all that can be handled on chain. Like we said yesterday, like we've been saying today, no need to increase back office headcount when you can just rely on the blockchain ledger for all of that. So from that is one angle, and eventually even to alternative trading systems or MTFs or different types of regulated trading venues that support digital asset securities and security tokens, tokenized assets, whatever nomenclature we want to roll with, that's always expanding. But that's really where the end goal is. And offering liquidity in these types of, just different asset classes that may already have it, but are maybe lagging, like we talked about earlier with the reporting times and the lags there, or even new asset classes that typically don't change hands at all. And if you're changing hands, you might be taking a 20 to 30% haircut just to get it off your books. And so even if you have, this is a common thing, even if you have maybe a 10% trading discount on one of these less liquid marketplaces, that's still an improvement on the 20 or 30% discount you normally take in the typical OTC market.
Oh, absolutely.
And, don't take that as the quote, because obviously it varies greatly based on asset class, on the asset itself, the market sizing, your own network, which is why I still think banks and existing players have a big advantage, and they should start leveraging this technology for the reasons we've been saying. If they're already running these types of deals, making their profits there, leverage this technology. You can increase your own bottom line, pass it through to your team, to your investors, roll it out into your own R&D activities in the space. I think that's really where things should be going and where the banks should be looking.
It's a no-brainer. It's why we're seeing some of these pioneering banks already looking at it, and for sure why I think the industry is inevitably headed there. So that, folks, that's the 4 phases of doing a security token
Yeah,
offering.
I'm sorry, real quick, just to go back to that slide.
Yeah, no,
Looking at it, I kind of got off topic there, looking institutionally, but looking at it really from the existing security token ecosystem as well. We have, lenders is one option. Eventually, people want to be, I don't want to say staking. People want to be, holding or using their tokenized securities to gain, just to borrow against. I'm losing my words here, just to borrow against, much like anything. And that's a simple transfer. If you have permissioned wallets or services, maybe a custodian in between that could facilitate that between Herwig and I as a major bank, and I'm an issuer. Cool, you could borrow right against your own investment. Additionally, when you're looking at managing liquidity on the secondary markets, we have seen a few different companies use tender offers or share buyback provisions. I think INX, Exodus, and Aspen Digital, and their St. Regis Aspen coin, and that's actually been quite successful. We're seeing it generate liquidity, or at least stir up liquidity, and investors are actually, if you go check out the chart on St. Regis Aspen, they're getting quite a nice return over the past couple of years, especially the past year when these buybacks really started happening. So again, the whole thing of tokenization is, go public while staying private, and these companies are making use of very similar provisions as public companies listed on NASDAQ or NYSE, making use of the similar just treasury and market management tools.
I mean, doing a traditional direct transfer for an investor would typically involve lawyers and a lot of approvals. Would be a very antiquated process. Finding other buyers would be very difficult given markets are so specific. There were very little, if any, broker dealers, except for maybe large startups that actually even enable liquidity for private companies. Lending it would be complicated because you want to try to find a valuation agent, or you want to even find a lender that's willing to go ahead and lend against a illiquid asset like that. And of course, it's very uncommon and it is an expense for companies to go through that process of setting up a buyback program, but not with tokenization. All of these tools, like a Swiss Army knife, become available to you just by leveraging the rails of tokenization. Now, of course, again, we are going to get a little deeper into that later on, but I do want to just summarize that this is the traditional way that people are raising money with their security tokens. I want to highlight, before we move on to some of these other use cases, that a lot of people look at the tokenization model and say, hey, again, this is a magical, great way to raise money. And they say, you should invest in my offering because we're tokenized. And we think that's a big no-no. We're not saying hide away from the fact that you're tokenized. We want to say highlight the fact that you're enabling features such as potentially secondary transfers, liquidity, collateralization, but by no means should anyone be investing into anything purely just because it is tokenized. I think we've seen that story and how it ends in the crypto world. So of course, people are going to care at the end of the day about what your offering is, which means you need great planning, you need a great structure, you need great partners in order to make this a seamless experience for all the investors to participate in, and for you to be able to distribute your deal easily to get to the eventual holy grail of liquidity, where we now have hundreds of tokenized products that have all gone through this process, now available on a variety of the different liquidity solutions that are out there. And as I have said yesterday, and as we're seeing each year, the number of total issuances just continues to explode, and we're going to see an insane amount of growth, I think, next year and the year after that in terms of just sheer number of issuances, because the infrastructure is here, folks. I think, Peter, and before you even joined in 2020, you might have picked up on a few calls where I was working with clients, and this process would probably be more like 6, 9, 12, 15 months to get through. And now we've had clients that probably can get through this process in 3 to 4 months if they did everything diligently. Right. So that's how the industry is progressing and advancing and making it easier to tokenize. If you're thinking about doing it before, it's now an even better time, of course, to get into it, and very an opportunistic time. But as we have learned at this conference, security tokens and doing STOs, if you will, that's just one facet of finance that is absolutely getting disrupted and transformed due to tokenization. So let's talk about some of these other use cases here.
Yeah. So I mean, we have the list up here, right, for anyone looking, but really it's, you know, institutions are going to have to save money before they can make money. And so looking at really how do we streamline what underpins all this when you see products, when you see investments happening, when you see capital flowing, everything has to flow back to the back and middle offices eventually in some way, shape, or form. And that's really where the lag, you know, it kind of happens. And so the more we can reduce those touch points, but the more we can reduce the days, any settlement, any transfer issues, whatever, a lot of it just comes down to different people. And there's if Herwig happens to be sick on Friday, now I got to wait till Monday for my thing to reconcile or to get a certain report I'm waiting back. If he's the end guy that I'm waiting on, you know, there's usually a fail safe. Someone else on the staff has to come in, but we know there's a delay there. If they have to get up to speed on whatever, simple issues like that. And it's kind of ridiculous that that's what's holding back so much of the capital markets industry, or not even holding back, but just slowing it down.
Yeah.
And so what we see a lot even from our clients looking at this is, okay, the more we can reduce touch points, whether that's with a DLT tech like blockchain, whether it's with one of these service providers themselves and rolling out a whole suite, you know, the better. And eventually figuring out how to commercialize that and enable it to just have tentacles into all the other lines of business is really the holy grail on that end. And it's just the next wave of technology.
Yeah. And it's what leading to all of these new use cases. So let's touch on a few of them. I know we've gotten pretty deep into the back office here, so I think we can move on. But again,
I would say these specifics here, it's easy to say, you know, digitize the back office, but it's really like the way we look at it is you're permissioning different parties into a shared mutual ledger. Otherwise, if you have Herwig's Excel sheet, you got to email it over to me. I got to check it out. Okay, I give my stamp. Oh, I found an error. Okay, let me update that. Send it back to Herwig. Oh, he's on lunch break at Chick-fil-A, knowing this guy. And then he's coming back. I have to wait. And I'm not getting these processes. And a lot of the viewers, I'm sure, these processes and this scenario actually does happen. And it's pretty ridiculous that that is how the flow is going. And just going back and forth on anything like that versus if we have one shared ledger, boom, right here on the table, I'm adding my side to things. If Herwig catches a mistake or something that needs an update, we're waiting on something, everyone around me can see, and we're all waiting on the same thing. As soon as Herwig submits, boom, we all have access to that in real time. No need to go back and forth on the Excel. It's like a Google Sheets except on steroids, because it's not even that you're waiting there. It's, you know, of course you see any changes in real time that are happening and anything pertinent. And that's how you could then bring your fund admins in, your accountants, your tax assessors, your transfer agents, the issuer themselves, and your reporting agencies even, which is a pretty good value add, even to the FINRA or the SEC, whatever. But that's really where you start to see these efficiencies come into play. You're reducing any shadow accounting, reporting to your own LPs. You know, if it's end of the quarter and they're still waiting a month later saying, hey, where's my quarterly report? How'd you guys do?
Which happens plenty.
And you can say, well, I'm still waiting on my fund admin to give me the final docs. In fact, so I can't even tell you anything because I'm in the dark. And now you're reconciling to make sure the fund admin did their job right. It's just kind of a ridiculous process all in. And this is the whole goal, to streamline that, bring it more to real time. And that's it.
I think it's super important to highlight that it's not just the efficiencies from automation and technology, but it is about that data redundancy, the risks of human error, right? Like, hey, if I make a mistake on one of these spreadsheets and now suddenly that's the trail of information that everybody is using off of, that's a huge problem. Whereas at least thanks to automation and thanks to this data transparency, everybody can operate on the same information. And I believe it was, you know, in a conversation with Pat Amaro, the CEO of Invenium, who mentioned that there was a firm that gave the stats for about the 70 finance professionals that they had. They had about 1,000 back office people to help make the people that make the money work, you know? So absolutely crazy stats that we're, thanks to this technology, we're going to see that number on the back office drastically get reduced. But that's not the only thing that's going to happen, because as we're seeing, and as we've heard from Wisdom Tree, from Franklin Templeton, and from many others, they're now taking the advantage, or taking the opportunity to take advantage of building their own channel so that they can control the experience and remove the, you know, concentration, the dependency on certain third parties that allow them to operate their business. You want to talk a little bit about that?
Yeah, definitely. So we've covered, a few of these actually the past couple of days, but looking at it, when you look at the private fund side, that's what we said before, even one of the examples, raising capital from the existing user base, existing investor base, if you will, is the bread and butter. This is where you bring all the banks in. This is where you have your go-to bank. You trust them to run the roadshow to find good capital and ultimately raise you the goal that you're looking for. But we're also seeing these same firms kind of complement this with, it could be a new tranche in a fund. It could be digital share classes, like what Providence Blockchain and Figure are really trying to push forward. It could be feeder funds. Securitize is always in the news with a new feeder fund with some big names, companies all over the world. Addicts we had on yesterday, similar deal with Hamilton Lane, with Partners Group, and they all have their own kind of unique value propositions. And the whole goal is, maybe my bank is only targeting the top few percent of wealth, and that's great, and they're probably going to continue to commit capital, but why would you limit yourself? If you're an investment manager that gets paid off of AUM fees and performance fees, the more money you have, the more you can work with. It's the old saying, permanent capital over constant fundraising. The more you can increase that capital base. And again, eventually, if you want to really get philosophical and theoretical in this, if things are tokenized as a GP, you have no pressure to really sell. You may have LPs to answer to, but if you can always provide them better avenues of liquidity, you're acting more as a permanent capital channel. And so these companies are already making use of it on the left side. I think it's very interesting. We're still seeing things in the primary market and the successful raises to come, but those will be headline making when they do. So definitely pay attention to that.
I love that term, permanent capital, and you're able to build your own community, your own audience of investors digitally like that. It's a lot easier to keep them sticky and invested, if you will. Now, of course, liquidity, this is that holy grail. Private markets, because they suffer from the lack of having marketplaces and exchanges actually trading these securities. That's a natural go-to, but most people don't realize that even a lot of the public markets and a lot of just finance as a whole is actually going to get disrupted by this technology. Let's give a quick couple examples on that.
Definitely. So one thing I love, and I was talking about yesterday, the JP Morgan's tokenized collateral network. Basically their broader base version of the repo network that was kind of their first rollout, I believe in December 2020 officially, underpinned by JPM Coin, JPMC. That Kieran kind of walked us through a couple days back, but really that's the deposit token that underpins all of the transactions within the repo side, and they've already done over 850 billion in repo transactions so far to date. The TCN itself went live with BlackRock and Barclays the other day, I think just Wednesday when we started this conference, as kind of the inaugural issuance on that, swapping money market funds. Just a new way for financing, for real-time financing, for improved collateral, look-throughs and transparency. Good for banks who have mandates to meet on the funding side, on the capital minimum side, right? And when you look at things overnight and how just hours do not line up globally, this is a tremendous value add. Similarly, you even have the regulated liability network, RLN, pretty much spearheaded by Citi primarily, but a dozen other banks. I believe the New York Fed is also involved. Basically, the whole thesis about superior stablecoin alternatives, CBDC alternatives, because that's definitely a debatable topic in the space. And this is something that's meant to basically be backed by a blend of deposits, of global currencies, of CDs, of money market funds, of treasuries, other cash equivalents, to basically create a blend and use that in a bunch of different digital systems. And then lastly, even Broadridge is also playing in the repo game with their distributed ledger repo DLR. They're doing 30 billion a month in repos. SocGen, DRW, UBS as a more recent user, and SocGen, as we mentioned, is already seeing savings of $100,000 per million transactions. Don't quite know how often that million is lapsing, but as we keep saying, these are the smallest of scale that they'll probably ever be. So the fact that you're even seeing savings is tremendous, and rolling that up at scale is going to be even bigger.
Trillions it's a big number. Now, liquidity is obviously that's thanks to that instant settlement capabilities and a lot of other features from smart contracts. But we're also seeing the banks test out bond issuances, right? And loan issues. We've seen a number of big projects all around the world. Not even listed on this document here is the European Investment Bank, as well as many other players. But let's talk about some of the ones that are definitely making a lot of waves. Project Guardian out of Singapore, definitely making waves.
Definitely one everyone in the industry should be familiar with by now. I mean, you're seeing JP Morgan, you're seeing HSBC, you're seeing MarketNode, you're seeing Temasek really work with in the Project Guardian initiative, and it's since kind of branched out. It encompasses so many different projects now. I remember JPM had that tokenized Singapore dollar swap, I believe, over a permission version of Ethereum as a part of Project Guardian. That was pretty cool to see collateral movement on a public chain in real time. You have different bond issuances coming out of some of the banking partners on that front. You have trade finance, which is another cool area, if you will, segment of finance that's being revolutionized, bringing letters of credit and the time down from 5 days to maybe just a couple hours. Again, similar to what we were just saying with all the touch points, you're not waiting 5 days for everyone, to say yes and to verify things. You're waiting a couple hours. It's on shared ledger. So that's all through Project Guardian. Even looking at the bonds and kind of with DeFi to an extent, Societe Generale and MakerDAO. MakerDAO is one of the original lending services in the space, if you will, and SocGen drew a $7 million loan from them back in January, posting their own tokenized bonds as collateral, as SocGen was one of the earlier issuers.
First on-chain refinancing that I've seen.
Yeah, pretty big name. And then, of course, you were yesterday talking about Figure and the Provenance blockchain-based HELOCs, already 6.5 billion in HELOCs issued on chain. It's about 7% of the entire HELOC market. I'm not talking on-chain products. I'm talking the actual traditional HELOC market. I mean, when that hits 10%, how could you ignore that if you're in the space?
You
150 bips of savings too, relative to traditional, enormous.
Now we do, again, there are absolutely several other use cases. We are running out of time here. We absolutely would be thrilled to go on and join us in the STA Success Network. We covered it yesterday, securitytokenadvisors.com, where we are doing this on a weekly basis from education, from research, and even being able to tap into office hours where you can talk to one of us or both of us and get into this more detail in person. But we do want to highlight some of these other services that we do beyond just advising and consulting you on your tokenization projects. As I mentioned earlier, a lot of folks aren't ready to necessarily pull trigger. They've got executive committees or bosses that they got to get approvals from. And in many times, we're able to play the role of basically putting together the right package of information, the right research, in order to go ahead and help that individual get it across the line, get the approvals needed in order to continue. We are also seeing a lot of actually now bigger banks and finance firms looking to position themselves within this space as thought leaders. And so we're excited to be collaborating on some content with them to release and co-create. One of the new things that we've really been taking advantage of is over the last 5 years being in this industry, trying to talk to everybody that is doing anything supporting this technology. We've built an incredible network of vendors, right, Peter? Over 50 across lawyers, around blockchains, technology platforms, compliance, marketing, brokerage, and everything else in between. And so there's an opportunity for us where we can actually go ahead and, as we've seen, I think throughout the conference, the more the ecosystem is able to work together, collaborate, plug into each other's technology, the better and more awesome this technology becomes. And so what we're doing now is actually going ahead and working with a lot of these infrastructure firms and doing some partnership development for them to help them, again, grow their ecosystem and their presence in the industry. And last but not least, much of what we did today is we love to educate. We speak all over the world, at universities, at corporations, for family offices and investors. We provide, very small sessions, or we can do an actual workshop or put together some custom education for you, depending on maybe a specific asset or a specific industry that you're looking at for tokenization. So we do it all. There is nothing we're going to shy away from, as long as it's related to tokenization, right?
Yep, absolutely.
And I would just want to highlight that, again, we've been working since 2018 in this space. We've had clients that have tokenized alternative carbon credit funds. They've developed real estate platforms. They've developed crowdfunding platforms or their own, solutions for the industry. We worked with blockchains. We worked with funds. We've worked with just about any type of asset class out there, which is one of the joys of being in this industry. And with that, please take the time to go to securitytokenadvisors.com and get to know us. And hopefully we have the opportunity to work with you on your tokenization project. And most of all, hopefully you learned something here during this session. And with that, let's head on over to, again, one of the most important topics you don't want to mess up, legal with Robin Sosno. Just give us a few minutes to get set up and we'll see you shortly. You can have great and productive conversations, but we're not lawyers. I want to make that very clear. So you need great counsel. And I've had the pleasure of knowing Robin here for, I think, a decade now, or close to it. Because of my previous compliance business. She is one of the pioneers, as we're going to learn, from around the Jobs Act era, which is the underpinning legal infrastructure that powers a lot of this tokenization stuff. And of course, she's adapted with the times and has now since been working on not just traditional Jobs Act related, opportunities and projects, but also now tokenized ones as well. And we even again, have been able to work with her ourselves, not just our clients. So I can speak firsthand just to say how amazing our experience was, how much I learned that I now get to share with a lot of you. But as you can see, Robin is thrilled and happy to share as well. So please, without further ado, Robin, tell the crowd a little bit about your background and maybe how you got into this whole space.
Hi, Herwig. Thank you so much for including me in this amazing 3-day event that you guys have really pulled off. I'm really delighted to be here, and I'm grateful for this super warm welcome that you just provided. So for those of you who don't know me, I'm Robin Sosno. I'm a corporate and securities attorney, newly minted attorney in the state of Florida, and more than a decade into my practice in New York. I own and operate a law firm with a team of 5 attorneys that are focused on the Jobs Act space, which, as Herwig alluded to, over time has really evolved and converged with the world of digital assets and digital asset securities, which are the primary focus of this conference and today's panel. So we work with companies that are raising capital. We work with funds that are raising capital. We work with platforms, some of which are regulated as funding portals or broker dealers, and others that are not regulated or exempt from registration as broker dealers and facilitate private placement type activity. We provide regulatory compliance advisory services and really try to support this ecosystem that we've been exploring throughout this conference. So excited to be here and to share some of the more finer points within the legalese of this all.
Yeah, but before we get to that good stuff, I do think it's worth discussing. What you're like me in a way where we came from that Jobs Act world. We saw this vision of equity crowdfunding is going to disrupt capital markets in its own way. It's going to put the retail investor first, and then suddenly this ICO thing came around and suddenly started, really disrupting a lot of this industry that had been building since 2012 in a very different way. And I think you are probably one of the few people like me who sort of had the experience already to know this is not going to end well. So maybe share with the audience, when was that first experience that you had with crypto in terms of, moving into this space?
Thank you so much for asking. So at the time that I was first introduced to the world of blockchain, it was early 2017. And I was operating Sosnow and Associates, which formerly was Law Office of Robin Sosnow. I've been a solo practitioner for some time, and I was growing. And my core focus had been Jobs Act topics. So early days of Jobs Act, it was really just online capital raising under Reg D 506C, platform representation and issuer representation. And in the next year, I think in 2015, the Reg A amendments came into effect, and I kind of shifted gears and expanded into that practice area. 2016 was regulation crowdfunding. And in 2017, I had pretty ample, relatively ample experience in these practice areas. And I was brought in to speak before a group of partners at Hogan Lovells to talk to them about the Reg A exemption and the mechanics behind utilizing it for a customer of theirs. And it turned out that that customer was looking to conduct a tokenized capital raise. And for me, the tokenization elements were brand new. I hadn't had exposure to blockchain technology at that point in time. But I very quickly realized that there was this convergence happening of the regulatory framework that arose with the Jobs Act, and then this new technology that had tremendous possibility for distribution among retail investor networks. So at that point, I really committed to expanding my skill set and becoming more involved in the innovation that was happening around me, and wanting to support that, but in a compliance first format.
Yeah, no, and that's one of the reasons why I truly appreciate working with you, because again, for anyone who's sort of new to this whole space, people like to refer to the alphabet soup of exemptions, which we're going to touch on very, very briefly. But a lot of the time, and really traditionally in history of the alphabet soup, most of it didn't exist up until just the last few years ago. And the one letter that was used was the one that was used for just about everything. So to have folks that actually knew what they were doing with these new exemptions that were coming out, there just weren't that many, frankly, even outside of Robin, that were really taking the time to become experts in this very specific aspect of securities law. And that's something that I've had to be able to learn working with dozens of different attorneys, that there truly are just so many different facets and topics and points of case law that you really need to find the right experts, the right lawyers that know what they're talking about for very specific, nuanced, and gray area topics like this. So I just wanted to highlight that and really put that light on you. But with that, you've since
I appreciate that.
Into it. Yeah. Well,
just add a comment. So, over time, the industry has evolved, including the crowdfunding industry, and there are resources for accessing counsel, beyond my firm, obviously. And one of those resources is the Crowdfunding Professional Association. So I'm on one of their committees, policy committee and attorney subcommittee, and we work with industry stakeholders to try to continue to improve access to capital in the US. And within my, just even on the attorney subcommittee, there are I think 10 other lawyers that are really invested in providing excellent legal services to the space. So I encourage everyone to evaluate some of those firms and those folks when investigating a capital raise that might involve one of the Jobs Act exemptions.
Yeah. And that's again another sign and a good trait of a good attorney when they know to tap in and even recommend other resources as well. That's why you can trust her. But I do want to again highlight that those probably other 10 professionals are probably of maybe a few dozen out of what one would imagine is thousands of securities attorneys that you think would be able to help with this. But no, truly, you should try to find those who are really in the space, folks. And with that, I think we can go ahead and shift gears. I'm going to go ahead and get the webinar or our presentation set up here. But Robin, maybe while I do that, can you quickly maybe just highlight some of the clients that you've worked with in the past, just to, show some folks, that you've really been in the space?
I'm here. I was having a little audio issue, so I just paused
you're good.
the speaking to see if that would catch up. Okay. Well, I think we're going to touch on some of these illustrative client matters throughout this presentation. And to your point earlier, I worked with you on the Security Token Group regulation crowdfunding capital raise that was hosted by Securitized Markets. We have helped facilitate the legals for Reg CF offerings, Reg A offerings, Reg D tech company offerings, and fund side offerings. It's always a sensitive topic of highlighting specific clients, without seeking pre-consents. But there are a few sprinkled out this presentation that we can definitely call out as we move through.
And I'll even add to that, repertoire, that even some of the infrastructure, not just the issuers, they've also, I believe, they've come to you to work on some pretty cool initiatives. But let's get into it. So go ahead, Robin. I'm going to pass it over to you. Please give us the basics for anyone starting to get interested in this.
Okay. So Herwig and I put together this presentation in an effort to make this legal primer digestible and engaging, so that it's not just like sitting down and reading a securities law handbook that would very quickly put anyone to sleep. So the core focus of the presentation is on the subject matter of primary issuance, right? The world of securities law, and if we wanted to do a broad scope legal overview, we could spend an entire day on it. So for purposes of the next 15-20 minutes, we really just want to focus on the concept of primary issuance. And to get that started, I thought it would be helpful if we just clarified what a primary issuance is, given the terminology, something that can sometimes be a bit in flux, and also to highlight the fact that Herwig's team recently put out a dictionary kind of helping clarify some of these things for the industry. So hopefully the summary definition that I provided here is aligned with what you guys have cited as well. But we're really talking today about the first time that a company is selling or issuing securities into the quote unquote public market. This is the first release point. This isn't resale. These aren't secondary transfers. And these primary issuances can be conducted either through a registered offering, which we'll touch on, or through a private exemption. An exemption from what? Exemption from registration, as is otherwise mandated under the Securities Act of 1933. So we flag some of the most commonly utilized exemptions from registration in the tokenization space. And those are those that fall under Regulation D, those that fall under Regulation Crowdfunding or CF, as well as Regulation A. Regulation Crowdfunding and Regulation A are what people normally think of when they're thinking of equity crowdfunding. Both of these exemptions allow for retail investor participation. Aside from that, they're actually quite different in their mechanics and their requirements. Regulation crowdfunding offerings, for example, have to take place on a registered funding portal or broker-dealer website. Issuers can raise no more than $5 million per 12-month period in a Reg CF offering. There are investment limitations on investors. There are advertising restrictions, despite the fact that a certain degree of advertising is certainly permissible. Testing the waters is permitted actually in all three scenarios. And there are really, big checklists of nuances, but just to give you some of the high level points for Reg CF, those are there. Reg A now allows you to raise up to 75 million per 12-month period per issuer. Kind of interestingly with Reg A, the 75 million cap is literally on a per issuer basis. So a sponsor team could set up multiple Reg A offerings within that year and raise 75 million for each offering, which is kind of a fun fact that often becomes quite relevant and is distinguished from the regulation crowdfunding scenario where you look through at management and that multi-entity capital raising strategy wouldn't work. You'd be limited to 5 million across all offerings. Reg D, Regulation D allows for unlimited capital to be raised from an unlimited number of accredited investors. And then there are further nuances on whether general solicitation is a priority or not.
Fantastic. No, and there are, even more, out there, but I think this is the majority of where people should spend their time, actually, working to figure out what is the right one to be using for their offering. I'm going to highlight really quickly that we have talked about in the last few days. There is the concept of a public registration. So everything we just talked about is how a company stays private and is able to essentially let the SEC know they're raising money under a certain rule, which means they're following a certain set of criteria in order to comply with that. Whereas with you actually registering with the SEC, you actually, of course, get the ability to tap into the full public at the cost of much stricter audits and disclosure requirements. So obviously firms like Franklin Templeton and Wisdom Tree, they've been, very capable of making sure that they can get their funds registered and on chain at the same time. In much of what we see in tokenization, we typically tend to stick to these private markets where you'll end up leveraging probably most likely one of these three exemptions. And in this case, we're going to give you some case studies to actually get into exactly what we're talking about. So with that, I'm going to hand it back over to Robin. Let's talk about, real estate, one of those hot use cases.
Okay, amazing. So within the world of tokenized real estate, first we feature just a few of the common structures that we see come to market. There we have these single asset deals where there's one piece of real property and that corresponds with one token, right? So the token represents 100% ownership in that property. And interestingly, there is a company called Proppy that is utilizing this model that we certainly support and that I wanted to showcase here. The second I cite a kind of throwback OG offering, which was the Aspen coin. It's kind of a loaded topic for those who are aware of it. So certainly no endorsements there, but I think that it is the first to market of this category. And this is where a single asset is put into an LLC and then fractionalized ownership within that LLC is sold off with one, let's call it unit of membership interest corresponding with one token. This is something that we're seeing, this model generally kind of dominates the market in and outside of real estate when it comes to the tokenization of assets. And then thirdly, I wanted to highlight something that I recently saw on the Securitized platform, which is the Mancipi Real Estate Investment Trust, which is a Spanish product. And they fractionalize ownership interest in a REIT. On the right side of the page, we just highlight that there are no restrictions. Use your imagination as to asset type and project kind of category that would be eligible for structuring in a tokenized real estate scenario. As we move into the next slide, we take a closer look at a platform that actually recently came to my attention called Honeybricks. I think Honeybricks is just a great example for a couple of reasons. But for purposes of this presentation, it really is a nice entry point to some of these Reg D topics that we started to speak about on a prior slide. So Honeybricks is operating a Title II Reg D platform. They are not a broker-dealer, and they are not required to be a broker-dealer to operate compliantly as they are. And that's because of Rule 201C of the Jobs Act. 201C is a new exemption from registration under the 34 Act requirement to be registered as a broker-dealer for an internet-based platform that's facilitating Reg D offerings. The scope of the exemption doesn't go beyond Reg D offerings, so they really are confined to that Reg D activity. And as a 201C exempt platform, they're able to do a little bit more than just providing that internet marketplace for connecting investors and issuers. They're also allowed to co-invest in the securities that are being sold on their platform, which is something that Honeybricks says that they in fact do. They're also able to provide due diligence services and also provide standardized documents for their customers, whom are those issuers' use. I think this is, I wanted to highlight this because I think it's a really interesting business model. I have quite a lot of people who come to me looking to explore whether they need to be registered or what the limitations and parameters are on their activity operating an internet-based platform. And many people aren't aware of this. So Honeybricks really allows us to feature that concept. The Honeybricks platform facilitates the sale of tokenized LLC interests. So think Aspen Coin, but they do this for third parties, and they also do this for some of their own products. So what that means is that they, as a platform, set up an additional entity to act as a syndication vehicle or as a fund vehicle. And they provide in the corporate organizational documents and corporate governance materials language that allows for tokenization and fractionalization in order to have the effect of being able to distribute these tokens that correspond with those underlying securities. You're on mute.
My bad. I actually love that use case too. And I do want to also highlight that many times you see issuers and they say, hey, how can I follow the footsteps of someone else like this? And we also see entrepreneurs and others say, hey, because I have a huge portfolio or a huge network, how can I replicate something like Honeybricks and create my own platform that I can sort of monetize? And that's something that Robin definitely can help on both ends. Let's move on to another case study here. I think this one's pretty unique. Maybe some folks haven't even heard this one. You want to explain creator finance for us, please?
Yeah, absolutely. So something we're seeing really trending over the last maybe 18 months is this somewhat new concept where creators, whether they're artists, musicians, influencers, internet stars, right, who are generating pretty substantial revenue for themselves and are starting to have a healthy track record, demonstrating their capacity to earn through content creation, of whatever form that is based on that activity that they're engaged in. And Gigastar Market is a regulation crowdfunding funding portal that we supported in their application to the SEC. They're now live, and I think they've launched at least 6 issuers offerings. A couple of them are Let's Talk Money, StockMo, Tax, and these are YouTube stars who are looking to sell off and monetize a portion of their future revenue. And they do that through setting up an entity that acts as the issuer and then entertaining a variety of behind the scenes contractual agreements that obligate them to disperse this portion of revenue to that issuer entity. And the crowd participates through the acquisition of revenue sharing units. And those revenue sharing units are tokenized. So when you go to the Gigastar Market funding portal environment and you make an investment subscription and it's accepted, you in turn receive a digital asset security. And that digital asset security entitles you to participate in those distributions if and when they occur in the future. This is really cool in my opinion. It's just excellent for this new kind of creator class, this new segment of our economy that's really emerging, and seems like it's going to continue just to grow and evolve as time moves on. It's also kind of a new expression of what a funding portal is able to do, both within the tokenization side of things, but also in support of these creator financings. Very briefly, these funding portals are registered with the SEC and FINRA, so they go through their own registration process on the front end and then continue to be subject to FINRA oversight as time goes on. We could have a whole discussion on that as well, and if anyone's interested, I'm happy
we
to
might have
discuss
to
it.
someday. We might have to, but I will say this hits all the buckets. I totally agree with you. It shows you a new asset class that, really anybody, even institutions, they couldn't invest in this. This is a new trend across the board. Although you do see now private equity funds buying the masters of very famous artists like Justin Bieber recently, selling his for, I think, over 100 million, or a very large tune. And it leverages tokenization to such a use case, tapping into distributions, potentially adding functionality down the road for token holders, for being fans, and being able to prove that they are super fans as a result of being token holders. And naturally, of course, the efficiencies of managing a whole audience of investors, thanks to tokenization, making that much easier for Gigastar to do. I absolutely love this example. I'm going to try to tackle this next one. We just had TokenizeThis on before you. Carlos gave a quick overview of the ecosystem that they built. And so I think that's the use case here, is it's not just limited to tech startups. Naturally, many other companies and funds, as we've heard, are going to TokenizeThis and similar platforms like it. I want to highlight not only the fact that we did an offering with them, which was a very cool experience, but the Exodus raise caught a lot of attention. And I think this is a very cool way to talk about the TokenizeThis ecosystem. As we learned, they have a transfer agent. So if you're going to go ahead and raise money for your tech startup, you can leverage their tokenization platform. You can leverage their transfer agent to manage basically to manage your back end, your cap table, and all your admin related governance. But if you want to do your own distribution, you don't need to go any further with TokenizeThis. You can actually manage this yourself and try to bring in your network of investors. Now, they also have a broker dealer, so they actually can go ahead and help you raise capital. Again, depending on which exemption, they might be able to not just host your offering, but actually be able to help find capital, depending on the circumstances, which is very different from then acting as that listing agent, which we saw do with Exodus. Exodus went ahead and they raised money digitally. They actually, a lot of that money came in from their own customers through their own platform, through that Reg A that they used. And then eventually they listed onto TokenizeThis and other platforms as well. So they went through the full ecosystem of how a tech startup can go ahead and raise which was at the time the first company to be tokenized to raise the full 75 million that had been changed from 50 that Robin had mentioned earlier. So a really great use case. Of course, again, very similar experience. Because Exodus is a wallet company, users had their wallets set up. They were very easily able to make that transaction happen. A really cool experience to see come to life. Robin, did you want to add anything to this case study?
My only comment here is from a payment processing perspective. I thought this offering was pretty interesting because they allowed subscriptions to be funded in crypto with like kind of this automatic feature where upon the subscription, the digital asset securities would be, automatically distributed into the wallet of the payee. And I hadn't really seen that before, but that's something that's taken off quite a bit since that time, where crypto as a form of payment is being integrated into more and more environments with kind of complex and webby backends that have to be really intentionally designed to make that happen compliantly.
Yeah, no, it was a very seamless experience for anyone who got to see that. The last one I just want to end on, since we are out of time, is the fact that you can leverage these kind of unique examples of 506B or C, just doing Reg D by yourself. You can leverage a funding platform, or you can go all the way by leveraging a broker dealer, or you can do this completely on your own. You can just go straight to Robin. Maybe you already have an amazing network. As long as you can fill in that tokenization and that hosting piece, which we went into detail in our How to Tokenize session just before, you should be able to go ahead and do this completely on your own without any help if you don't need it. I think a really cool example I want to highlight is Mercedes-Benz Financial Services. This is the financing arm of Mercedes-Benz. They're actually responsible for all of the leases that they do for their Mercedes cars. And one of the sources of capital that they raise money for is a demand note program, which essentially enables customers to buy into Mercedes notes that give you a return. They seem to try to stick to the treasury type competitive rates, but it's backed by Mercedes-Benz, and it's in a bank account that you can go in and out of, and they're using 506C, and they've raised billions, over $1 billion through this method without necessarily needing to tap into any of these other solutions. So just wanted to highlight that everything is possible, but it's only possible with the right support. So I highly encourage you that if you are in this space and you're looking for an attorney, to consider reaching out to Robin, so that she can go ahead and give you a good setup or good guidance, or even better, if she can actually work with you on what you're doing. I imagine you'll be very pleased with the results like we were, but unfortunately we are out of time. Robin, did you have anything you wanted to close on for our audience?
I'm super grateful to be here. I appreciate all of the support, and I'm certainly here to help. So if you want to reach out and have a legal matter to discuss, we can get on the phone and go through it. Thank you, and good luck with the rest of the conference today.
Thank you, Robin. See you soon for the next session, everyone.
A digital advice, a self-directed investing, a FinTamp, and a digital model marketplace. With the limited time that we have today, my colleague Peter will present a comprehensive overview of the Fusion IQ platform. He will cover both the traditional finance and the digital asset experience. For those of you interested in learning more about Fusion IQ and potentially leveraging our technology, please don't hesitate to reach out to us via this current platform, LinkedIn, or email following the presentation. With that said, I'll turn it over to my colleague, Peter Britton, who's going to give us a walkthrough of the platform step by step. Peter?
Thank you very much, Sean. And for all those who have joined us today, as Sean mentioned, Fusion IQ as a white label front-end solution is working across multiple custodians and multiple asset classes. The screen that I have up is an example of one of our RIA clients. This is a production environment, and they wanted to be able to offer managed portfolios across equities, ETFs, mutual funds, digital assets, and then bolster their offering with a self-directed brokerage experience specifically focused on digital assets. Before I log into the client portal, I will quickly show the onboarding workflow. Fusion IQ, at a high level, we are a digital workflow. through the lens of a client as well as an advisor or registered rep. So I've taken the liberty of pre-filling a risk tolerance questionnaire for our digital advice platform. So based upon how I answer my risk tolerance questionnaire, or RTQ, I will go ahead and get mapped to a corresponding risk tolerance category and portfolio. You can see here that I've selected an interest in digital assets related portfolios. We'll give this a moment to load, let the algorithm work behind the scenes. And so you can see here, I've been mapped. I've got my portfolio composition. I can take a look, see the corresponding weightings. We're going to pull in the logos, company descriptions. And from here, I could go ahead and select this portfolio. And I now will go through the AML, KYC, and identity verification process. Again, we are an API-driven environment that will be dynamic in nature, responding to that end advisory client's investment experience. For instance, if I select a joint account, it's going to populate the ability to add a primary applicant and a co-applicant. Again, this is for, and the example is a managed portfolio under an RIA. It's also going to respond, for instance, I have my Series 7. So if I select an affiliation with a broker dealer, I can upload a 3210. I can even add compliance as an interested party in the investment experience. So it is a 100% digital account onboarding experience. We separate it into multiple windows, and then at the end, we'll give a single field to review all the information. As Sean mentioned, depending upon how fast you can type, on average, you're looking at about a 5-minute onboarding experience. And I'm going to go ahead now and actually log into an existing client portal and show you both the managed portfolios that are going to have traditional assets alongside my digital asset portfolio. And I'll actually go ahead and transact as well. So when I first log in to the client portal, you'll see here that I have 4 active accounts. If I click through, this digital advice account, leveraging fractional shares, it's $99 in this example, but it could be larger and it could be smaller. I can jump over to my holdings, where you'll see through my managed portfolio, I have those traditional assets. We're going to display the gain, loss, concentration. I can click through, I'll get my tax lot information. So really the theme of Fusion IQ as a white label B2B offering is the consolidation of multiple investment experiences, but also just the entire investment experience for the advisory client within the 4 corners of one application. So with that in mind, I'm going to have all of my previous sales, my orders, activity associated. When it's tax season, I can come into the environment. I can pull not only my custodial related documents, but also my tax related documents. I can establish an ACH relationship with the custodian downstream electronically. We have an enterprise agreement in place with Plaid. We pull our clients under that, and we can also facilitate traditional means of funding as well. And now for the fun stuff. As we move away from the traditional experience and keep the focus on digital assets, I can now log into my digital asset experience. And if I jump back one screen real quick, you'll see that when I go to my dashboard, we're ingesting multiple custodial data feeds. So here I have my digital assets alongside my traditionals, and it's not just data aggregation as I'm about to show you. We're taking it a step further and making it a transactional environment as well. So again, using Oliver Investments as the example, they wanted to be able to bolster their offering to meet advisory client demand to not only have managed portfolios that they are actively, again, managing and rebalancing, but to complement it with a self-directed experience for digital assets. Through this environment, I actually have access to 18 coins that can be held in both qualified as well as non-qualified accounts. So you'll see here, for today's example, I'm going to go with the tried and true. I can enter in both an amount, dollar-based or quantity, alternating between the two.
Peter, I think one thing to, just to interject, one thing to say is, with regards to everything being a security token focus for this conference, one thing to keep in mind here is while we're showing you Bitcoin and other tokens of that nature, as security tokens start getting are being added to the various custodians in the market, we will be able to ingest those tokens, not just for viewing, but actual activity on those tokens, buying, selling, etc., as appropriate with your portfolio.
That's exactly right. and that's the beauty of the way our developers and our CTO have built the platform, the flexibility that it lends itself to. While we show an example in one area, it's not limited. It's a very modular based approach. So I can come in, you can see my holdings. You can see here on October 13th, that Bitcoin transaction that I put through. Completed status, previous settlements. My dashboard, we're going to tie in, a couple of screens, popular investment options, my portfolio overview. We'll pull in crypto news. It's templated, so we can modify the data fields as well, depending upon, what our clients are looking to display. So again, keeping that flexibility as a common theme. We covered the trading. And so we can deposit additional funds, pull up the prices and charts. So really, again, it's that theme of consolidation. Here we have a web-based example, but we are also live mobile. A few ways to approach mobile. Some of our clients have existing mobile applications that we can embed our solution within, and we can also build dedicated mobile apps on behalf of clients. I mentioned at the start that we are a digital workflow, and thus far we've covered it from a client perspective, but we also are facilitating on the second half of the equation an environment for registered reps as well as advisors. So this is where, again, the digital workflow can be leveraged for opening new accounts. Because I want to be conscious of time, what I want to pull up is our consolidated views tab, where we have, again, across multiple custodians, the ability to filter. So I can pull up account numbers, first name, last name. This one is a pre-production environment just so that it's not real data or customer information. But I can click through, I can pull up an example, quick snapshot. I can view, get a little more granular with the details. So I have my summary, holdings, previous sales, again, everything living within one environment, eliminating that swivel chair that many advisors face, and have faced for quite some time.
And I think it's, Peter, to add to that, obviously, real estate on advisor's desktop is important. And so with everything we're doing here, we're doing away with having multiple screens, multiple programs, this program integrated to that program. While we do support, a large number of integrations, at the end of the day, what we've found is advisors want this in one platform. They don't want to have to go pull data out of here to get to there. And so it is a very comprehensive approach rather than, the piecemeal approach that we see, a lot in the market today. And something, that I'll add on this is that when it comes to, Peter might be able to pull this up, but when it comes to the models that you put together as an advisor, advisors are traditionally have, equities, fixed income, alternatives, etc. What we allow is we allow you the ability to take it a step further. So you can incorporate now additional asset classes into your models and apply those not across just, one client, but across your entire, client base. So, it's taking the digital asset, as an actual asset class now and incorporating that into the overall picture of an actual customer's portfolio.
Yeah, and so while I pulled up that consolidated views tab, I don't want to reveal all of our secret sauce. So for those interested in learning more, happy to schedule one-on-one demonstrations. But to Sean's point, we are facilitating portfolio management, the ability to incorporate multiple asset classes within those, but also to subscribe to a digital model marketplace where you can leverage third-party strategists. So some of our clients, they might have a strategy that's great for a conservative or a moderate investor, but they're looking for, going out and finding something that might cater to an aggressive or something that's more esoteric than they've, incorporated to date. So they can leverage the digital model marketplace on a subscription model to pull in those additional strategies, as well as build their own within the IQ portal or advisor workstation.
Absolutely. And I think, to add to that, Peter, with the platform and what we have today, while we currently work with, about 6 different custodians, our platform, is really client driven. So if clients have other custodians that they would like us to integrate with, those are things that as part of our sales process and demonstration when working with customers, we can definitely incorporate into their needs or into the solution so that they, again, have a comprehensive offering, and are able to operate out of one platform rather than have multiple platforms.
Yeah, when I first, started positioning this in the marketplace, I used to call it the cable box, but I've updated with the times and I now call it the smart TV. The question becomes, what applications are you looking to download once that underlying foundation is built? We have clients that might start with, digital advice and traditional assets, or they might start with, self-directed brokerage within the world of equities, ETFs, and traditional assets. And then they want to bolster because they're receiving, end client demand for, expanded product offerings. So it might be HBO and Netflix to start, and at a later date, we want to pull in Showtime. The beauty of, again, the flexibility of the platform is we can, and it's entitlement driven, it's a permission-based system. Some of our clients go as far as view only, and others want transactional environments, and some are in between on the spectrum. But really, I just want to reinforce that flexibility and the ability to meet our clients' and clients' demand.
Yeah,
Platform.
Yeah, and something to add to that, Peter, is, obviously, I'm not going to call it a crypto winter, but, while crypto has been down from its highs, what a lot of service providers are facing is a single revenue stream. So, they're looking at it from maybe they just offered, digital assets and crypto, and they want to expand that offering out to other asset classes. This is something that we see from our prospects and customers, that they're looking, they want to have a more comprehensive offering. And so with the Fusion IQ platform, not only is it, able to provide the digital onboarding and all the ancillary components, but we're also able to open up new revenue streams for, these firms that are, going through this phase right now. And then when you think about it from a holistic point of view, if I put my, self-directed, I want to manage my own account profile, I would say, I want as many options available to me. And that's where the whole security token piece comes into play, because the plumbing is really the important part. The pieces, the security token, which chain you're leveraging, which type of underlying asset that security token is servicing. Those are things that are going to happen be adopted at a custodial level. And then from the custodian adopting those pieces, we're able to actually leverage what they're offering and give it to the actual end users, which would be the advisors and their end customers, or the individual investors that are looking to enter into these assets through their qualified and non-qualified accounts. I'll take a pause there. Definitely not sure if we have any questions, but definitely excited to continue to see the growth in the digital asset space, particularly in security tokens and the various associated blockchains. Here at Fusion IQ, we continue to evolve the platform. And as I mentioned at the beginning, this is something we do believe in. That's why we've added it to this platform. And it's something that we're seeing, customers request, I would say more and more now. And especially as, you see the spot ETF market and various things come to life, we're well positioned ahead to service customers in that vertical.
Yeah, and so I do see that we have one question just in terms of the growing demand for exposure to digital assets, and just to emphasize the points that we've covered in Sean's comments a moment ago. It's really a matter of our clients are looking for ways to differentiate themselves and to offer, because in this day of consolidation, you need to have not only internally multiple revenue streams, as we've covered, from a diversification perspective, but as our clients are trying to stand out from the firm down the road, or down several blocks, whatever it might be, they see the ability to add multiple investment journeys as that differentiating factor. And so it's a matter of that's certainly shaping the increased demand that we're seeing currently.
And to that question, I see in there, with regards to the custodians. I mean, at the end of the day, we are agnostic when it comes to the custodians. We are customer driven. So, irregardless of what if the customer is looking to add the digital assets, security tokens to their platform, we're positioned to allow that. I mean, that the custodian that they would like to leverage, has the necessary APIs, has all the framework for us to integrate. Keep in mind, it's not just a front end. It's there's all the tools that take the data in, ingest it, and then are doing the necessary activities to keep those portfolios, in line, bring on new portfolios, etc. I think we still have a minute left if there's any questions. Otherwise, again, feel free to reach out to us, fusioniq.io. We would love to set up a time to walk those who are interested through the platform. And those that are, still dipping their toes, don't be scared. We're happy to, give you an overview as well. With that said, we'll turn it back to Jason. And thank you again, everybody, for your time today, and to the security token market team, and look forward to connecting with those who are interested.
Fantastic. Well, thank you very much. Very informative. Everyone, go ahead and contact Fusion IQ if you're interested in learning more. We'll direct you now to our next session in the next few minutes, selecting a blockchain. Thank you all.
Maybe I will pass it off for a roundtable introductions here. Ryan, would you like to kick us off?
Sure, yeah, absolutely. First, thank you for the opportunity and appreciate Security Token Markets for putting this on. My name is Ryan McNay. I work at Republic Crypto as a tokenization advisor. I've been here for a couple of years. My previous experience was running a Web2 business, which was a mobile and web development agency based out of Washington, D.C., and have been around the blockchain space here for about 10 years now. So super excited to get into this conversation today and share what I know about the space.
Fantastic. Who wants to go next?
How about you, Lou?
All right. Hello, everyone. I'm Lou Morgan. I'm Chief Technology Officer at Black Time Financial. I spent 30 years in the CFTC, SEC world as a member of the Chicago Mercantile Exchange, partner at a broker and dealer. Got into blockchain 2017. We started Black Time Financial. kind of saw the need for an infrastructure company for broker dealers, investment banks, credit unions, financial institutions, and really excited about being here. This is great.
And last but not least, Matthew, thanks for having me. Jason and STA guys, thanks again for letting me speak. Anthony Morrow, CEO of Provenance Blockchain Foundation. We are a sovereign layer one built in the Cosmos ecosystem, spun out of Figure Technologies almost 2 years ago, and now sovereign and decentralized, and becoming more so every day. My background is very much traditional financial services. I spent 2 decades at BNY Mellon, running various security servicing business, particularly ADRs. After that, I spent 3 years running an NYSE listed real estate investment trust, and found my way to Provenance about 15 months ago, and will be doing this easily for the rest of my career.
Yeah, there's a lot to do here, right?
There's a lot to do here.
There's no shortage of work when we're changing the pipes at such a basic level.
Sure.
So, on that note, let's talk about layer ones. First and foremost, does the blockchain we choose actually matter for different tokenization or various projects, or can security tokens and specifically be blockchain agnostic?
I'm happy to jump in if that's okay.
Yeah.
Obviously, I'm biased. I have to put that out there. I run a layer one, so I'm obviously biased. But I think it matters very much. People have said it doesn't matter what road you travel on. And I think, if you're on an interstate highway, that might be true. But if one blockchain is an interstate highway and one blockchain is a dirt back road with potholes and alligators and crocodiles and people throwing rocks at you, one road is safer and one road is less safe. And I would say that is true for layer ones as well. I would say that, right now, I don't know how many thousands of layer ones there are in the world, but, B of A and many others have written that the future at some point will be a very small number of blockchains, because those are the only ones that can be able to support themselves with fees. And I would argue that for financial services, there'll be, one or a small number of blockchains. For gaming, there'll be a small number of blockchains. For NFT art, there might be another blockchain that's very purpose-built for that specific use case. So Provenance is purpose-built for regulated financial services, and we really have 3 things that means. What does regulated financial service, built for regulated financial services mean? Well, it means 3 things. It means the technology, the ecosystem, and the governance that are very unique to what we're doing. So first of all, in our governance, we're public, which is important because now you have a whole ecosystem building in your blockchain essentially for free for the blockchain foundation. But we're properly permissioned for financial services. And what does properly permissioned means? It means you can't write anything you want to the protocol. In every open source and permissionless blockchain, you can put any code that you want on the blockchain. And what that does is it opens up risk avenues, cybersecurity risk avenues and others that we've seen. If you're going to be a good control location for financial services, which is what a layer one blockchain needs to be in this industry, you can really never be down. You can never be hacked. You always need to be up and running and available for trading, because obviously the hour that you're going to be down is the hour that the markets are most volatile. So properly permissioned and doing things like KYCing validators and ensuring that only approved software goes on the chain that is only built for the financial services ecosystem is really important. 2 is the technology. And technology is important, but most blockchains, open source, permissionless, and public blockchains want to be an everything blockchain, if you will, sort of the Walmarts of blockchains. And that's fine for a certain business model where you can turn the base protocol into gaming or NFTs or metaverse or financial services, but it's not great if you want to do one really, really well. And what that means is, for the ERC, ERC 70 or ERC 3643 standards, you need to put a whole bunch of smart contracts on top of the base protocol to get to a layer on which you can start to build. With Provenance, we start with our marker protocol, further than the ERC 3643 standard, meaning there's no smart contracts involved before you get to that standard. And then you can put some smart contracts on top to get to your specific use case. And what I'm trying to say is each smart contract, as everyone knows, invokes some degree of risk. So the fewer smart contracts you have on top of a base protocol, the better. You have cyber risk, you have expense, you have third-party risk. And as real regulated financial services institutions move into the space, less risk obviously is better than more risk. And then third is the ecosystem. Our ecosystem is, this is my last point, I'll stop, is by far the largest in real world assets. Figure Technology has led the way with home equity lines of credit and mortgages and other assets, which I'll talk about later.
Yeah, awesome. Yeah, that's really, I think you're looking at this from the perspective of, keeping the cost down of operating the blockchain and having a very purpose-built application. We definitely see a lot of conversations in that space where people are looking at purpose-built versus, purpose-built for a specific project, cloning a blockchain, taking an EVM, putting it into a private hosted environment versus using public infrastructure. I'm curious, Lou or Ryan, do you have any thoughts on which blockchains to select and why?
We took a little different approach. Anthony wasn't around when we started, so we had to take a little bit of a different approach. We started investigating blockchain early on. We looked at Ethereum. We played around with Hyperledger for a while. Hyperledger had I was being sponsored a lot by IBM. IBM had a project called WorldWire, which was a worldwide payments network. And we started poking around that. That's pretty cool. And it was running on Stellar. We looked at Stellar. We looked at Ripple. Ripple was a little closed, so to speak, at the time. You had to be kind of in the club to get on board. Stellar was open source. And we looked at that and we said, okay, this will work for us. We come from this world. It was purpose built for financial transactions, which we knew that was our space, right? So we started developing a platform infrastructure for Stellar, hoping that our target clients would come around and see that this would work in the long run and provide a lot of efficiencies. And thank goodness we've got some examples out there now. Franklin Templeton, Wisdom Tree, MoneyGram, all running on Stellar. So we're pretty happy with that. It's got a lot of the things that financial institutions need. There's a built-in DEX on layer 1. There's built-in liquidity pools on layer 1. We're about to go live with a smart contract platform that's probably state-of-the-art Rust programs compiling down into WASM, running on a VM that's super fast and super efficient, maybe an order of magnitude less in cost. So we're pretty excited about that. That's kind of where we sit in the space there.
Awesome, thanks, Ryan. Any thoughts?
Yeah, no, absolutely. I think I love the hearing the thoughts from both. I think I take a little bit of a hybrid approach here at Republic because we do remain chain agnostic for the most part here. So the way that I look at it is the blockchain is simply the foundation or the pavement in this case, if we're talking about roads, and then the token developers and issuers kind of organize the roads on top of that. So what we do is whenever we have somebody come into us, they usually go through our advisory services in which we'll develop economies and things like that if we're talking about utility tokens. But more so than that, I really take pride in this where it's more than just selecting a trending name. It's really about aligning project objectives with platform capabilities or protocol capabilities. So I like to look and I conduct my protocol analysis here with my clients in 3 buckets. 1 is objectively, 2 is subjectively, and 3 is actionably. And so from an objective standpoint, right, if a client is coming to us with a utility token, we'll analyze documentation that our shout out to our killer economics team puts together. We'll digest all of that. But even if it's just a business coming to tokenize something, right, we'll intake all of these documents to really look at the usage demands that their product will need of the blockchain of their choosing. On top of that, we also have a number of different matrices, internal data rooms that we use to compare blockchains whether that's transactions per second or cost per transaction, wallet support. One of the things that I really like to think about with blockchains is things like developer and community support. I've run into so many situations where documentation is incomplete and you're actually relying on the community to help support. So I really like to look at that, as well as future roadmap development, right? It's going back to aligning projects with protocols. So that's from an objective standpoint. From a subjective standpoint, right, we have a lot of clients that come to us that have already started conversations with protocols, whether that be they have a relationship or they're looking into the grant or venture funding out of a protocol. We will take those in and we will take that into consideration, as well as blockchain specification. I think we were kind of talking a little bit, Anthony had mentioned about like gaming versus DeFi. So we definitely and certainly look at that. And then actionably, it's still a small unit. We are in crypto. So we make sure that all of our teams have open lines of communication with all protocols to make the best decision for them moving forward. We really want to make sure that the protocol that they choose scales with them and provides the value that they're looking for. So that's how we approach it here at Republic.
Cool. That's fantastic. When you guys look at different blockchains or you're assessing or different people, there's often a 2x2 classification of public blockchains on the top versus private, and then permissioned and permissionless. And I think we see a lot of different examples of this in the market. And I'd be curious, with the customers that you guys work with, Ryan, do you see interest in private and permission blockchains, or is it generally using more public blockchain infrastructure?
Yeah, we have clients from all over, a wide array of clients, and I would say most of the time you still run into kind of like that blockchain trilemma, right? Which is security, scalability, and then decentralization. You kind of got to pick two of the three. So it really depends. I think with each use case, we're wildly different. We work with a large array of founders and enterprises coming into Tokenize. So that's a hard one to answer. Maybe pass it off to Anthony and Lou and what they're seeing with people that they're working with.
So how we're solving those problems here at Provenance is we're absolutely seeing the demand for private and permissioned networks from larger asset managers and just about every bank in the US, because the regulators are telling them that that's the way that they need to proceed. And that is an interim step, I believe. I think the overall debate in crypto blockchain is that public is clearly the future, but the present is a mixed. And banks and large asset managers, as I was saying, are have the need for private and permissioned, but then they also want to make sure that their private and permissioned network isn't a dead-end street, to go back to our street analogy. They want to make sure that it's interoperable into other areas for a time in the future, which everyone believes will come, when public but properly permissioned is the route forward for banks and asset managers. So again, we were built in Hyperledger Fabric 4 years ago when Mike Cagney started the Provenance chain. They moved over to the Cosmos ecosystem 2 years ago as Cosmos started to develop. As people more technological than I can talk about the merits of that versus the EVM chains. But more importantly, it allows the IBC connection, inter-blockchain connections to other Cosmos-based networks in a, I'm not going to say completely safe, but in a recognized safe transition. So within the Cosmos, you're able to spin up blockchains pretty much for every use case. So we obviously have our mainnet with our big pool of validators, but the banks that are operating, and we're working with several, are all operating on private zones, we call them. It's not unlike an Avalanche subnet. They're called private zones in the Provenance ecosystem. And in that zone, you can create every aspect of your chain, whether or not whether you have gas or not, how gas is paid. Is it paid in US dollars or hash, or do you have zero gas? How many validators do you have? What's the permissioning look like? All that is available in a zone. You can, it's essentially a private sandbox. And at some point in the future, when you're ready to, it really is a very simple transition into mainnet, or they'll also then into mainnet into anywhere else in the Cosmos ecosystem. And this is important because we've seen a couple of private permissioned blockchains go out of business. And if you've got assets that are very specifically built for those private permissioned blockchains, where do you go? You have to rewrite your code. You have to transition all your assets. You have to disrupt your investor base. It's not a good look for the industry when that happens. So interoperability is key. Being able to move from private to public is key, and these are all the things that we think about all the time.
Great. Lou?
Yeah, I would agree. Interoperability is key. Our clients have asked for a couple of other blockchains just to be redundant. So while I'm not an expert in them, we have had development in Algorand, Avalanche, Polygon. So we poked around in those. There's great aspects to all those. We probably haven't seen, we're probably in a little different space than Anthony is, in that some of our clients are not tokenizing, they're interested in payments, things like that. So we kind of have to look at a little bigger picture of things. So we kind of lean a little bit more towards the permissioned public blockchain, permissioned assets on a public blockchain, which Stellar does pretty well. There's other blockchains that do that well also. So, but we're in a, we can be in a little different space than Anthony is. And so that's kind of where we're at.
Awesome.
We'll do a deep dive after this, Lou.
Yeah, totally. So I'm curious, there's something, here around the conversation around interoperability and, the holy grail of all the blockchains meshing together seamlessly.
Yeah.
What's from the different perspectives you guys have? What do you see as some of the barriers to that interoperability today?
So I can jump in. We're working on. I talked about this a little bit, and we had our third quarter call the other day. And the names will come out next week. I wish they were available today so I could talk about them. But I'll just say a very large U.S. bank has its own internal blockchain network, and they're building an interoperability project with ourselves via Axelar to other large asset managers, with the goal of having a client on their internal bank network having an alternative asset portfolio and being able to index it and, importantly, rebalance it with an interoperability through, again, Provenance Axelar into the Provenance ecosystem. So we've got a couple of funds. Apollo has a big fund on Provenance, and there's others. But if you wanted to rebalance that portfolio, let's say investment 1 was up 60%, investment down 2 was down 10%. How do you rebalance that back to an index across multiple blockchains? So interoperability is the key, and firms like Axelar, Layer 0, are providing a way to make both private and public blockchains interact with each other in a, I'm not gonna say completely safe, but a safer way than has happened in crypto trading before. And again, if you're within Cosmos, great, but we recognize the world isn't yet all on Cosmos. You have to be able to go between EVM chains, private chains, and other blockchain networks. So look for that announcement in the next week or so. They're going to do a big demo at the Singapore FinTech Festival in 4 weeks' time. So I think it'll be one of the cooler projects that gets announced.
Yeah, I think you hit on the holy grail there. We saw this all in the in the financial markets in the late 80s, early 90s, where everybody had to start getting connected to each other, right? All the ECNs had to connect to each other, and it was a bit of an issue. But then we had the fixed protocol come along, and the same thing will happen in blockchain technology. We're going to call that bridging, right? And we're going to be able to bridge between different blockchains, and the bridges themselves need to be trusted. Okay. And when we have bridges that are run by trusted entities, and this could be by banks, broker dealers, some regulated entity, we're going to see an explosion in business, I think. And then people will be able to run on a blockchain that suits them. But if somebody wants to just buy and hold something, they can move it to their blockchain or do whatever they want. Maybe they have to move USDC a lot and they need a cheap blockchain to do that, but they need to maybe trade on provenance. So
And that's exactly where there's several ATSs in our space, and obviously there's not enough business to go around for all of them right now. NASDAQ, you're absolutely right, Lou, evolved as a collection of broker dealers, and then the predecessor to NASDAQ was the NASD. Before that, it was actually FINRA, who put an electronic communication network across all the broker dealers. And hey, lo and behold, NASDAQ exploded in liquidity. Rise of tech didn't hurt either. But the liquidity that was enabled by the ECN that went across, it was safe, effective, cheaper, faster, and safer than the telephone bid system that came before it. So we need that moment in blockchain. It's not in blockchain trading. It's not here yet because there's no real secondary market liquidity really across any private asset classes. Is not a blockchain specific issue. But when that comes, blockchain will support that network in a way that it never would have grown without that.
Yeah, and I just, I love that everyone's touching here on interoperability. I think that is one of the key points, especially that we emphasize here, interoperability. A lot of clients that I'm launching right now, a little bit on the utility side as well, are EVM compatible chains. We always recommend them to be near mainnet, right? Always near Ethereum. They can bridge to other L2s if necessary, but the bridges themselves, I believe, need a little bit of work. We've seen a lot of changes, some unannounced changes, or not highlighted changes to some of these bridges. And I think as we're still an early industry, as we move forward, these bridges will get better and more secure and safer, and we'll feel confident moving assets in between bridges. And I think that's when true interoperability will shine.
Fantastic. So I'm curious, from our perspective, we've worked with, again, many different blockchains, and it is usually, I would say, similar to what you were saying, Lou, is, the creating the permissioning infrastructure for a public chain has been a lot of the work that we've done in the space. My area of focus has mostly been in the EVM compatibility network as well. So, when we're looking at different blockchains, one of the things that we had to consider is that, certain blockchains from a legal or regulatory compliance perspective weren't necessarily suited for certain applications. And I'm curious, when you guys look at these projects, do you ever see anything from the compliance, the regulatory compliance, where a certain blockchain might favor another one, and why?
was that for me?
For everybody, whoever, if you jump right in, yeah.
Well, probably, I can't remember exactly. It was probably about 3 years ago. The regulated institutions started poking around on Stellar, and one of the things the SEC said that you have to have is clawback provision, and you need a revocable, so that if there's fraudulent activity, you can revoke an asset from an account. That was a whole protocol change for Stellar, not a change, an upgrade. That was protocol, I'm going to say 18. And that gave the ability to, I think, the Wisdom Tree and the Franklin Templetons of the world to be able to issue a regulatory compliant on Stellar, regulatory compliant asset on Stellar. So that was a big thing. And if a blockchain wants to issue a regulated, if someone wants to issue a regulated asset on a blockchain, they need that ability in the United States if they want to do it compliantly.
Yep. I would just, in addition to freezing, I would say forced transfer and ownership roles and wallet identity and compliance rules, sanctioning, all these things that regulated financial services has, a blockchain needs to have as well. And going back to some of the benefits of provenance, these are all toggles in our marker. You can select them or not when you spin up a new marker for a new security. They're not smart contracts that you have to write in. I'd also go back to the cap table, right? My first year in Bank of New York, I learned everything I could about transfer agents and cap tables. because that's where securities start to get ledgered. And if that's not done right, everything else falls apart. We also have a cap table and ledgering ability within Provenance. And again, being built in the protocol makes a very big difference, because if it's in a smart contract, any changes that happen anywhere else in other smart contracts or in the protocol affect each smart contract. So having to go back and redo all the smart contracts really creates a vector for risk. So, we understood all that. We thought through all those issues. We have some security servicing experts within our shop, and we designed the protocol to be, expert for security servicing, and it really has resonated. Another thing that's really important is escrow and exchange. On most blockchains, when you want to trade an asset, you have to pledge the assets to the blockchain and they get frozen, right? And only the transaction only execute once, both sides are met. But you could have a bid, encumbered and sitting out there for months if you wanted to. We have capabilities where it stays within your wallet, and it's escrowed in your wallet, and it only transacts when the transaction happens. But more importantly, you get to keep control of it, not the blockchain transfer agent. There's things like that we're thinking about on an everyday basis that really make a difference.
That sounds like a really cool feature.
Yeah, and love to hear these as well. I think the way that I look at it, right, is the blockchains are where the security tokens are developed and issued, but the blockchains themselves aren't capable to encompass all of the features required for securities right now. And so I think a lot of that is built on top of that. We introduced something called ERC, 1404 is an older standard, but we introduced 1404 Prime recently in combination with a token developer named Upside, which is really interesting. But there's an example like the SEC doesn't allow for sole recording of ownership to be done directly on chain. And so we have to handle that KYC AML functionality off chain, right? And so I think as we're continuing to build this out, you're going to, as I mentioned, the blockchain to me is that road. And then the issuers and developers of the tokens will actually build the roads on top of that in the way that we navigate security. So I think a lot of that functionality may come into play there, at least how I'm seeing it from my side right now.
Yeah, we need to talk also, Ryan.
Yeah, 100%. I can't wait.
Yeah, we saw all those issues. I mean, frankly, ERC 3643 is a great standard, but how many smart contracts do you need to get there, right? This is all literally built in the protocol on Provenance.
I'll be hitting you up after this call.
Yeah. I just want to, thank you everyone who said, mention also to anyone in the audience, if you want to submit any questions, you can use the chat feature in the Zoom, and those should end up popping up in the feed here. So we'll watch for those. Go ahead and post any questions if anyone has. As we moving forward, when you're looking at the blockchains, and of course, a completely private blockchain, private doesn't necessarily mean it's not decentralized. And so does the decentralization level of a blockchain matter for the different applications that you see? Or is it, certain blockchains you can move a proof of authority and essentially centralize it all to one point, right? Consensus protocol, or you could choose to also move it to something like more of the public blockchains where there's still a proof of work element or proof of stake, etc. So does the consensus algorithm matter and the level of decentralization matter with the customers that you deal with?
I mean, it has to, right? So if you have a private zone on Provenance, you could spin it up with 3 validators, and how decentralized is 3 validators? Probably have a dozen validators, but the more validators you have, the more expensive your private network becomes. And it starts to change the benefits of a blockchain. So it's a consideration for sure that those wanting private and permission blockchains need to have. I really think it is an interim step. So, for instance, the way that we're dealing with cap tables, and I absolutely hear you, Ryan, that the SEC doesn't want. The source of truth can't be on blockchain right now. It's really one of the technologies that they mandate, which is odd, but it is what it is. So what you have is a pseudonymized cap table on blockchain, and then the off-chain transfer agent just keeps the master key of what the pseudonyms are. You can do KYC and AML on those pseudonymized because you know who they are at the end of the day. It's coming. innovations, and these are all little innovations that add up to a big deal. But back to, private zones and private and permission chains, they're never going to be as robust as the public network. The economics are different, the tokenomics are different, but it is an absolutely needed interim step until we get to more public.
Excellent. Yeah, thanks.
Yeah,
Ryan, Lou,
Go
any
ahead.
thoughts?
Go ahead.
Oh yeah, just a quick note is when we go back to like the blockchain trilemma, security, scalability, decentralization, and trying to choose the two of the three, one of the things that I think about is the decentralized nature of housing security tokens may be, from my perspective, not as important, just because the assets are already transfer restricted. And then like considering on a public blockchain, I actually heard this, it was a really good point, was one consideration for securities is that transactions may be coordinated, settled, and rewarded by validators who are like participating in nefarious or illegal activity, and thus issuers may be rewarding or indirectly compensating illegal activity. And it was a really kind of interesting point that was brought up. That's been sticking with me, and I'm giving it some thought. So that's kind of just my perspective again. But as things are changing, like Anthony said, we're going to be learning a lot here.
Yeah, that was a good point, and that was Anthony's point yesterday. And so we've seen people interested in speed and cost, right? And that leads to kind of which blockchain you might go with just based on the consensus algorithm, right? So there's proof of work, proof of stake, federated Byzantine, all kinds of, there's a lot of them out there, right? And some are greener, some are cost intensive, some blockchains burn the transaction fees, some reward the validators. That all comes into play and is a consideration for some people, right? That want to issue, they're going to have specifics that they're going to have to adhere to for a blockchain. So all those things come into play.
Yeah, for sure. And it's why I think general purpose blockchains aren't fit for regulated financial services. They're absolutely fine for a lot of use cases. And crypto trading, the crypto world all of a sudden discovered real world assets as crypto volumes declined. But it's hard to adapt a crypto mindset into traditional financial services. What I think is going to happen is traditional financial services are going to adapt some of the best practices from the crypto industry, and we're going to meet in the middle.
Yep. Yeah.
Absolutely.
Speed is super important for crypto trading, and it would be if there were equity trading on chain as well. But it's not super important for trading mortgages or credit or private equity. I mean, these are not high frequency assets, and a 5-second block time is absolutely fine for trading these assets.
Yeah.
Oh, absolutely. And the number of when you're looking at these private markets, tokenization of private capital, private equity, etc. The cost of the transaction, even if you use online database Web 2 solutions, is still like $20 to $100 a transaction, and yet a security token could execute that for a lot less. So that's really quite fascinating. I think when we're looking at the comments here, we've got questions. We have a question for Ryan. 1 second here. We have a question for Ryan asking, can you rank order the level of interest you're seeing in blockchains and which blockchains are people asking for? So I don't know, do you see a top 3 or 5 list with the customers that you deal with, Ryan?
Yeah, at the end of the day, we remain chain agnostic. We see some similarities in projects that we are working with, especially on the utility token side. A lot of them they want to be near Ethereum mainnet, main chain, L1 if you want. They will also look at things like Polygon. A lot of people are starting to talk about Base, which I'm really excited about. I'd be hard hard pressed to give an exact ranking of these, because it really, as we go back to my original comment, right, it's project objectives with protocol specifications, and so we try to match those two. So it really varies depending on use case. So that's a hard one to answer, but yeah, some of the popular ones are certainly there at the top and in consideration for our clients.
Mm-hmm. What about Lou and Anthony, from your side? Do you hear people looking at, hey, if you're on Stellar, like why not Ethereum? Why not Bitcoin Satoshi Vision? Do you hear any of those types of questions?
I mean, we've been focused on institutional financial services, really not crypto. I mean, we'll have crypto trading in Providence at some point. Figure is building a marketplace. They believe that we'll do both securities through an ATS and digital assets through a DEX. So that will probably be done on a private zone of Providence that has a smaller block time. But the use cases that we're focused on mainnet really are regulated financial services. And as I said, time doesn't really matter. But what we found is you need to do things cheaper, faster, and safer than TradFi, not necessarily the crypto world. So other chains are absolutely fine for those use cases. But I think, again, if you can spin up cheaper, faster, and safer versus TradFi, you're going to win. So every blockchain, I think, will be cheaper and faster. But I think everyone else falls down on safer, right? Is your blockchain safer than different risks for sure, but are they diminished compared? Are you de-risking financial services use cases? And again, that's where our technology and our ecosystem come in. And I like to say, so the only industry that's been disrupted by blockchain anywhere in the world is home equity lines of credit, and that's what Figure and its partners. They've got 10 of the 20 largest mortgage originators on our platform today, on Figure's platform, which uses Providence, and they've issued 6% of all HELOCs that have been done last year and this year, which is a massive number if you think about an asset class. Like no other asset class that we speak about in our blockchain world has, I would even think 0.1% of that asset class has been disrupted. This is a full 6%. So it's going to be asset class by asset class. It's going to be user base by user base. And, having issued $15 billion of securities all institutionally, it's important to say that, if these were done in the crypto retail world, the crypto retail press would go crazy, right? If you, instead of doing $15 billion to, a handful of institutional investors, you did $15 billion to, 30,000 crypto wallets, the crypto world would go nuts. But in the asset-backed securities world, $15 billion is really not a lot of money, right? To me, it's a lot of money, but to the EBS world, it's not a lot of money. And in the crypto world, it would just blow everybody's minds that you could do that much real world assets.
Yeah, there's definitely the numbers are still very small within the crypto space, and I think there's a lot of starting to develop. There's a distinction that's starting to develop about the idea of blockchain in financial services versus blockchain in the crypto use case. And this is where the consideration of, do you use a public chain, a private chain, ecosystem start to really make a big difference, because it's not the same. The use case, the customers, everything is very different, right? The needs are very different. And so how do you get the benefits of blockchain without necessarily taking on additional new risk? It's a big part of a lot of people's decision-making. iComply has been working in this space for 6 years. I've been doing it a couple of years before that, and we've seen definitely trends of blockchains, right? There's, Ethereum, and then, another chain here, and then another chain there. We see layer 2 Bitcoin, we see Stellar, we see Solana. There's a lot of this stuff happening, even in financial services applications. And so, at the same time, we do see these private chain and private network applications like central bank digital currencies. I don't think a lot of people don't realize, but there's already a testing platform for central banks, and several central banks have live central bank digital currencies running on an EVM clone called mBridge. And, that's running in a private, I think probably an Azure type of environment, but a private POA network. And so we see a lot of these different takes coming at it from one way or another, people tackling it in different ways. So I'm curious, when you guys are looking at the decisioning of community with a blockchain, I think that was something that each of you have kind of mentioned, what are the different benefits when you're thinking of provenance? Is there a strong development community? Is it easy to find stakeholders and partners? And same thing even with what you're doing in Stellar and of course your space, Ryan.
Yeah, the ecosystem in Stellar is big. I had the good fortune of attending the World Conference in Madrid a couple of weeks ago. There were over 500 developers and advocates there of the chain. I'm really happy with that. It gives me a little comfort. Yeah, I think I like that. When I'm looking at other chains, when my clients come to me and say, yeah, we'll do Stellar, but give me, I need a backup, right? Because I'm a regulated financial institution. I can't have one chain. So then we go through the list of the ones that can handle their asset. And then I have to go look and say, well, that one only has 10 guys on their Discord channel. And that's going to be a really tricky one to develop for. And then, that I kind of look at that kind of stuff, right?
Mm-hmm.
So.
Cool, thank you.
Yeah, I could jump in real quick. In terms of like community and developer support, I mean, it's just something that I would say more so that I run into on the utility token side of things. The one thing is I look at commits and GitHub and who's contributing to the code base. That's a super important metric to look at. You're always going to need help from someone, right? And so whether that be the actual protocol itself and the engineers on the team or developers, they've been super helpful and got me out of some situations as we've been developing here. And then third, and again, this is more of a reference to like our utility clients, but if you have a lot of people contributing to the network and who are developing on top of it, you can also find a lot of early adopters who are willing to work on your product, not necessarily just work on your product, but be a part of that ecosystem, test it out, and you're getting really valuable feedback there. So you just want to make sure that there's a community around this protocol. It's been super helpful for me.
Yeah, and I'd agree with all that. I'd say that Cosmos is an ascending technology. I think DYDX just moved from ETH to Cosmos. That was kind of a big deal because they wanted to control their own environment. It's just a different way to look at a blockchain network. When I was at Bank of New York, we had to have a living will and a resolution and recovery plan. And I think that needs to be an important step if we are, as a blockchain layer one, going to be a good control location, i.e. what happens to you if the chain ever went away or shut down or was hacked. A lot of other blockchains who are blockchains that aren't in the Cosmos ecosystem don't have the ability to transfer seamlessly. And IBC allows you can move from provenance to osmosis or DYDX literally with a push of a button in a completely safe manner because it's built in the internet of blockchains. As I said, it's an ascendant technology and you benefit from thousands of developers in the Cosmos ecosystem. But, so we take parts of that code, but we can also develop our own that is meant specifically for the Provenance network. So it really is the best of both worlds.
Wow, fantastic. Well, we've got a few minutes here. I'd be curious, is there any thoughts from each of you on other things that people should be considering, other than the questions that we've covered, some key takeaways as people are looking into tokenization and maybe trying to assess how this would impact their organization, what are some of the risks they have to think about, etc.
I'll just say I think it's the first or second batter in the top of the first inning for this industry. I think it's a very interesting time. I think the secret formula is cheaper, faster, and safer than traditional financial services. And I think we're starting to build out all those paradigms right now. I think the immediate future for the larger institutions is private and permission with a roadmap to public and properly permissioned. You got to get the blocking and tackling right. It's a security service for what we're talking about, tokenizing financial assets, obviously. It's a security servicing construct mindset that you need to think about. How do you perfect assets? How do you ensure that there's no double hypothecation of assets? Asset protection is absolutely key, because when things go bad, that's when the networks get tested. And you always have to be up, and you always have to be, doing the right thing. So it's not a sexy story, financial services blockchain. I've spoke to some, media. They said, "Where's the sexiness?" Sorry, we don't have the things that make the headlines going on in our network. We are at our core a custodian of assets and a security servicer, building products for rewiring the operating system of financial services, and that's what we do every day. And it's going to get more exciting all the time.
Yep, we're Joe the plumber, right?
Yeah, totally.
Yeah, I think just final thoughts are here. When you're choosing a blockchain, make sure it's the one that suits your asset, right? Make sure that your blockchain is going to be scalable in the future. Make sure it's good and decentralized. Make sure there's a good ecosystem in there so you can get help when you need it. That should get you on your way.
Yeah, I echo all the same sentiment as both of you, Anthony. I love the sports references. Those are great for me. But I would say the same exact things. And I know there's probably some people that, again, I focus a lot on both security and utility tokens. And the one piece of advice for if anybody's doing a utility token on my side or listening, don't always. Every client that comes to me, they get really their eyes open wide if they get a check from a venture team to come build on the blockchain. Make sure that your project needs are met by that blockchain. Don't just go for the first check. You want to be able to scale with this project. Look at the roadmap, look at the community support, make sure they're going in the same direction you are, because this is setting the foundation for the rest of your business. So that's the only extra tidbit that I would add on at the end there.
Yeah, that's fantastic. Thank you. And I think just waiting to see if we have any other questions. It's a last call for anyone in the audience. But I think one of the things that we see a lot of is in this space as people are looking at it, like you were saying, Ryan, is a bit of like, I heard about this one blockchain, so we have to do it here. And taking that approach of really assessing, and you mentioned even a whole matrix of decision you're going to hold it, I think is super important. So I'd like to thank everyone for, sorry, what's that? Go ahead.
No, I was going to say, I just almost thought of this as I go through protocol analysis with future clients, is to actually just put protocol 1, 2, and 3 at the top, hide the names, and let them choose from there, because everybody gets attracted by the blue light, the next big thing, and it's really like focus on what matters, and that's the fundamentals.
Yep.
I don't have a good sports reference there, but I'm sure you're cooking one.
Build it and they will come, right?
Yeah, there we go.
Excellent. Well, Jason, are you still with us here? Anything you'd like us to do before we wrap up?
No, just wanted to thank all of you for your time and sharing each of your perspectives with our audience here. Obviously, selecting a blockchain is something that comes up in conversation for every issuer, at one point or another. So thank you all for your insights there. I'd like to direct you all. Before that, actually, thank you, Matthew, for moderating and doing such a great job. Thank you for that. We're creating great content for our audience here. So that being said, we are at the end of this hour. So we will direct you guys over to the next session, which will be distribution strategies by the Security Token Advisors team. So bear with us while we transition up here. And thank you very much, all.
Thanks, guys.
Thank you, everyone.
Thank you. Bye.
Tokenization fun, if you ask me. But today we're really getting into the weeds of it. Hopefully you've already learned a lot. I thought that was a great set of sessions that we just followed on with. We're covering the legal, we're covering how to evaluate blockchains, as we've pointed out. We're getting to our journey now regarding distribution and marketing, which we're going to follow and end on with liquidity. So right now, the important thing we're going to focus on is, as we mentioned before, essentially the ability, or how you're going to plan for being able to raise the actual money that you need, which again has really not a lot to do with the technology. It makes it easier, but it is not the core components of what you should be focusing on when you're thinking about your distribution strategy. So the considerations we're going to be covering on this session is, of course, the narrative. This is the hook. This is what people buy into in order to understand what the opportunity even is. We've got our target investor types. It's extremely important you don't just spray and pray and go as loud as possible and hope that the money will come in. The more accurate and focused you can get your marketing mix, your understanding of who your investors are, the easier it will be to convert them and reach them properly. We've of course been talking about the deal room. This is important. This is the actual meat that really usually gets the investors over the hump and making that investment. So we want to talk a little bit about that user experience, and last but not least, of course, part of your marketing mix of all the different ways you'll leverage distribution partners and other traditional marketing solutions in order to get that word out. Other words, Peter, it's fundraising on steroids.
Right, it is. Are we looking at things from a globalized base as always?
Exactly right. So let's get started off with the most important thing, right? Building that narrative. It's at this point one of the most viral videos in the world. Simon Sinek's why versus the what and the how. I think it's very easy for many people to go into the what. What is the investment? What are you buying into? What is the company or the opportunity? The how. That's where, again, we mentioned try to spend as little time as possible. People care less about how they're going to participate. It's cool that it's tokenized. It's not the reason that they're investing. And then, of course, the why is the true, tapping into the alignment within the consumer, within the investor as to, they align themselves with you in terms of your mission, not what you're doing, but why you are doing it. And so the message, probably needs to be concise and clear. Huh, Peter?
Absolutely. What we see even from our clients, there's usually something pretty specific they're leaning into. This is a tough, raising capital, it's no easy feat, especially when you're going distributed. It's a much wider base and you have a ton of potential there, a very high ceiling. But to really meet that ceiling, you also need to be pretty specific. So it's tough to kind of see, I don't want to say commoditized investments, but let's say you're in something like, you're in the real estate space. You should have some niche or theme that really resonates with investors. Otherwise, now you're competing with the entire real estate market in this space, and it's becoming pretty broad, right?
It absolutely is. And I think time and time again, we know people have a vision. Our clients, they come in with a specific mindset. And many times it may be extremely clear to the visionary, but it's not so clear when they try to translate that vision to others. And this is where that narrative comes to being able to take that elevator pitch and really make it digestible to the point where you can understand it in an ad, right? The idea that I can be online, I can see an advertisement for an opportunity. Why am I going to click on that? This is a whole new way of thinking about raising capital. Beyond, of course, trying to make a very clear message that will bring in the investor and make them understand why you're doing this. You want to also focus on the traction. This is something that is time and time again proven in traditional markets. I think it was really illustrated in the crypto markets, and it applies all the same here as well, which is, you don't want to be going into this thing cold. You don't want to be, telling people they're going to be the first investor unless there's a really good reason why they want to be that first investor. Because when it comes to raising capital in a transparent manner like this, whether it's an IPO, a traditional private placement, an ICO, as we saw in the crypto days, the traction is everything. You want to do everything you can in your possible so that when you go live, you are going to be building into or already have traction for your fundraise. There's a known fundraising statistic that came out of the crowdfunding days that basically said that, you really should always target roughly 80% of your goal as your target. Why? Because if 100% of your goal, which let's call it is 10 million, you're going to struggle to reach that 10 million versus if you reach 5 or 6 right away, you already say that you hit your goal. Now you're oversubscribing, and that's an entire different narrative to the investor as oh, they're halfway there versus, wow, they've already done it and I still have an opportunity to participate. So, engineering that traction, making sure that people can see that progress. It's one of the benefits of transparency with tokenization, that you can actually see a progress bar, the success of a raise, other engagement by other investors. And I'll go beyond that, which you don't just want to have traction for your fundraise, but you need to have your KPIs down. Traction in the actual business, right? What are your key performance indicators that if you're talking to me for 1 minute, you've got 20 seconds to tell me why and what I'm investing in, 20 seconds to tell me the traction, and you got 20 seconds to explain to me not just the traction with the raise, but the traction with the business itself. And these are usually key KPIs that anyone can resonate with. For technology, often it's the growth of the user base, or for traditional businesses, the growth of revenue. It really depends across different asset classes. You want to try to identify what are those key KPIs that maybe throughout the raise are increasing and growing to show that momentum, or just to date, before you go live with your fundraise, here's how amazing your company has been. And it shows investors, you know exactly what you're focused on, what performance indicators matter, and therefore will be focused on once they raise the capital, right?
Very well said.
Yeah, I think I'll end it there with just saying that, again, this is easily one of the most challenging components. Many people came into this space thinking that tokenization could be that solution to raising capital. It is not. It does not. It makes it easier for the investor. Again, lower investment minimums make it easier for an investor to participate. Potential liquidity solutions make it easier for them to not lock up their capital for a long time. That digital access makes it easier for them to participate, but it doesn't change your offerings, KPIs, your traction, your messaging. Moving on from the narrative, the narrative won't resonate if you don't have the right investors, right? So let's talk about some of the different personas and the different types of investors, Peter, that you've seen enter into this space and participate. And it's a bit of a loaded question because everybody should know by now, tokenization is pretty much across the board.
It definitely is. I think something we've seen, family offices are a pretty good target. I won't say target like that, but pretty good lead, if you will, depending on the focus, the asset class, just kind of given their constraints or lack thereof. Extremely flexible, and usually, at least what we see, family offices want to kind of be ahead of the curve. They don't always want to play catch up. And, as things become a bit more comparative between family offices and VCs, they do want to kind of get on that up and up, start competing a bit more heavily in that regard. So I think their family offices are pretty receptive to tokenized offerings, either as issuers, which we're not really talking about here, but as issuers, and also potential investors. We've kind of seen that firsthand, in fact, and that would go alongside, you could say, the kind of lower level angel investors. And again, it really comes down, if you guys remember the earlier panel we were hosting, on the legal side. And are you going direct to retail, or are you going to retail, or are you going to accreds, are you going to institutional investors? And what's really cool about even tokenization, you could have multiple tranches. So to Herwig's point here, different personas, different investors, different tools. You could have multiple tranches that have different targets based on the crowd you're looking at. It'll be a different game going to one of the top 10 asset managers, or different RIAs who have certain lockups needed, who have certain controls, certain operational metrics and whatever that they need to check out first, versus going to the average Joe on the street. Not on the street, but through a portal, even bringing angels and family offices into that similar round. So it's kind of
I think that's well put. The reality is I think you illustrated it perfectly. You can't just sort of pick one and say, this is it. There are so many different options. You really have to take the time to review who you think will be the best susceptible to you. And to your point again, you may want to consider multiple tranches. You're not going to go to the world's largest asset managers and venture funds first, right? You're going to want to try to get some initial traction with some angels or some other capacity, so that when you go to those people, not only do you have that traction and KPIs, you also have some leverage, right? That it's like, look, we are raising capital. We don't necessarily need you. That is one of the beautiful things that I think comes to the table from tokenization, is unlike traditional markets and even in investment banking, it's a club, and you need to penetrate into that club. And a lot of the times, like the VCs, they all know each other, so they take advantage of being in a club and can use that against you. Whereas if you create this mechanism where first come, first serve, anybody that qualifies can invest, you're putting a time pressure, you're putting a clock on anyone that you're talking to, and you're not necessarily treating them that much differently because you don't necessarily care where the money comes from, unless it's a strategic investor, in which case, for sure, you may throw in some extra incentives and things like that. So, again, really understand who it is that you're trying to reach and in what stage of your offering, so that you can identify exactly who they are, how to reach them, where they are. Angels will obviously be living in angel groups and be typically predisposed to technology and other type companies, but there is a huge accredited investor universe of real estate investors on crowdfunding platforms and other places. That's an entirely different type of investor, despite them both being in that accredited bucket. And you're going to reach those investors in a very different way, even more nuanced. If those real estate investors, you're looking for big tickets, or if you're looking for a lot of small tickets, the way you're going to reach those people is going to be very, very different. Moving on, we now have an idea of what you need to cover and how to reach them. But at the end of the day, you can bring them to the table, but it won't matter if you don't have a proper deal room, a complete deal room, as we like to say. It is one of those things that investors absolutely not only use to actually do due diligence, but it shows them a lot about how strong of an operator you are, how transparent you're going to be, how organized you're going to be. And in the typical world where this used to be a folder of documents or a business plan, it's now evolved to use storage solutions. So now we can at least have a bunch of PDFs that we can share in one zip, if you will, or on a Dropbox folder. But now we have graduated to the world where instead of just receiving a box, if you will, or a folder of information, we've now made this a marketing tool, right? If you go to any crowdfunding page, if you go to many of the tokenization platforms and marketplaces that we've talked about throughout the conference, you'll see that they all have a design to standardize, making it easier for investors to go through deals on their platform, so they know, oh, I can click here to see the employment agreements, or I can click here to see what business sales agreements that they've signed. I can click here to go to the pitch deck and see the video. I can contact them here. This is something that is new. That was before ad hoc, different with each individual deal. The way Peter prepares his deal room might be very different than the way that I do that. And now tools are making it easier to standardize this and make it easier for investors to not only actually see the information, but it actually may be more designed and user experience wise to help guide the investor towards an investment. You might have an investor come to your deal room, love everything that they do, but boy, if you structured and set it up so that it's complicated for them to make the next step and invest, you may very well lose them at that point, right?
Absolutely.
Anything you want to add here?
Nothing. The standardization is there's kind of what's happening. Just in a lot of digital deal rooms are coming up on across any asset class, institutional level, retail level, but standardizing it is kind of where we're headed.
Exactly, and I think you're going to see it standardized, like you said earlier. I think in very different specific asset classes. Again, why it would pain you to go and seek out the right partners for your
I think
deal.
what's also interesting here, and this is kind of an aside, but even as you look beyond the primary fundraise in the deal room, obviously there's ongoing reporting, right? There's ongoing assessments and whatever that you have to share, that you should share with investors, depending on what you're doing. And a lot of the tools we've talked about Invenium, we've talked about different issuance platforms, brokers, anything on chain data wise, is really where that also comes to play, kind of a tertiary role. Reporting, instead of having, as you scale your operations as a company, instead of having your back office have to gather all these docs for LPs and investors, which could be thousands of them in this case, you're just drawing data from the most recent change.
And I think it's a really valid point beyond that of, well, I can take your word on it on paper.
Yep.
But again, leveraging technology and partners like this, I won't have to directly take your word for it. You can go ahead and bring in third parties that can validate that data so that I'm not just taking a risk about what you're saying for face value. I actually know, oh, wow, this was appraised at this rate, or, oh, someone checked their financials or went to their offices. You get the idea, right? And I will point out that, of course, this technology, we've been saying it makes it super easy for investors to participate, potentially taking on thousands of investors all at once. Without necessarily having to scale that human back end. But we will point out that, we're not quite there yet industry-wise, where investors are used to just clicking buttons and investing and going through the process. We do encourage, of course, to have some kind of human support, human touch element in play in case an investor wants to call somebody or be instructed on how to go through the platform, et cetera. It definitely helps when it comes to closing the deal. Now, believe it or not, Peter, have you seen companies come to the space without any budget in mind for marketing?
Yeah.
Yeah, the answer is yes, folks. Can you believe that? Again, this is not a simple solution that magically raises you money.
You can't just issue a token and hope they come. It's not the case.
Yep, you need to treat this like a traditional marketing campaign. In the traditional fundraising methods, it would look a lot more like you're putting it all on yourself. You're gonna reach out to investors, pitch them manually, hope to bring them on board after you send them your deal room. You sometimes may go a step up from there and leverage a broker dealer, and they're interesting because the way they're structured and legally allowed to, which make sure you look for this, that if someone is trying to bring in capital for you on a performance basis, if they are not a licensed investment banker with a broker dealer, they actually cannot be doing that. You need to be an investment banker to do a performance-based deal where they can actually say, instead of me giving $100,000 to a marketing campaign, I can say, you know what? Don't take any of my money, but I'll give you 5% of whatever you can bring in. This is, of course, much more friendly towards anyone raising money. And the performance aspect, of course, limits the potential risk, where if they don't bring anything, you didn't really lose all too much potentially. Whereas if they bring in a lot, you at least know exactly how much you're going to pay for what they brought in. But that's an opportunity, folks, because now that you can introduce traditional marketing, there is this concept of cost of capital. Ultimately, what did it take you to raise the money? If I needed $1 million to raise $10 million all in, our cost of capital is 10%. And so now that we can, enter the marketing mix, if you will, we could actually, in this example here on the slide, for example, if you spent $400K on marketing, that's 1% cheaper than if you were to go to a broker. So, I don't know about you, but $100,000 is a lot. So if I have an opportunity to potentially save that instead of having to rely on the traditional mechanisms, well, again, that's the opportunity here. And you have to keep in mind that you have your marketing cost of capital to acquire investors and capital, but that is only just one component of the full mix of fees, which of course you've got legal fees, you're paying all the technology vendors, you might have compliance fees and other fees sprinkled in. You want to add all of that up to really understand your cost of capital. And truly, other than the opportunity to tap into new audiences and new features and benefits from this technology that are hard to quantify, it is easy to quantify what people paid in the past and how you might be able to save that kind of money using this technology today. So we're going to continue to see this industry, I think, develop and get clearer channels that are alternatives to brokers that make it much easier to potentially reach the audience that you're looking for in a more cost-effective manner than per se just relying on a broker dealer. Anything else you want to add on this?
I think it'd be interesting to see what the broker dealers activities are as well. There may be overlap between marketing and them. There could be a blended fee structure. And I mean, we've certainly seen a range just in the crowdfunding space and the tokenization space as a whole relative to traditional fee structures. So it's another thing to kind of evaluate and see where the overlap is.
Yeah, I think that's a great point. And of course, it's a great transition point as well, because that's exactly what we're talking about now, right? Is you're creating a mix of different channels that you can evaluate individually to measure the performance, double down on what works, and strip whatever isn't. Again, giving you potentially a more effective use of the capital that you have, allocated in order to raise the capital as a whole. So it's important to go out and see, based on your narrative, based on the investor types that you're trying to reach, based on your budget and your marketing mix. It's very important to identify all of the different channels that you could potentially go to, and then work backwards to see, okay, this company's audience isn't necessarily as best suited for me, or this initial investment to test this channel is much cheaper. So we can go ahead and learn more about the capability or the success of that channel. And of course, you then go ahead and double down and want to leverage this either mix of brokers, which could be one broker, a broker tying in multiple brokers. You could be tapping into different communities and marketplaces. Simultaneous to that, you may have your own network that you're tapping into, that you're sending directly to you, so that there is no third-party split going on there, as well as leveraging those marketing channels that you can now tap into, which again, there may well be a future where we're going to start seeing lots and lots of digital ads for investment opportunities, just like you would any other type of e-commerce solution. We're talking about newsletters. We heard it from my co-founder at Invest Ready, right? We have a database of over 16,000 verified accredited investors. They've all been verified because they invested in a deal. And that platform is a compliance company. They don't have a broker. There's nothing special about that, other than recently there's been a newsletter allowing these investors to see all these other opportunities that they now qualify for, since they've been verified. And that's just a traditional marketing spend to be able to sponsor that newsletter and hopefully get enough clicks and interest to, of course, justify sponsoring it. So you're seeing a whole traditional world get almost upended and improved, because it's not getting destroyed. It's just getting made better to be able to work with other channels, as well as just more efficiently as a whole. Well, as we come down to our last 5 minutes here, we talked about it with Robin on our legal session earlier. I think the Exodus use case is a prime example to be talking about, because they tapped into their own customer base on top of outside capital, which is one of the best use cases for a Reg A plus offering. When you've already got a large audience baked in, you can take advantage of that audience through tokenization by enabling all the tools and technology, as we pointed out earlier, where Exodus enabled all of their customers to, on their website, through the wallet technology that Exodus actually manages and created, to essentially trade into their company, into Reg A shares via an atomic swap via crypto. Which is pretty fascinating, because they built a whole user base that they now, instead of going to traditional VCs and such, they managed to raise from them as well. Now, I don't know the full makeup and mix of how much they raised between retail and institutional, because I do know that they also received capital from some institutional investors and some VC types. So therefore, they did not have to sacrifice one or the other. Which I think, again, it just shows that you can stay private, tap into your customers, leverage tokenization to give a lot of the features that everything you would have wanted if you were to go public. Now they didn't have to do. Seems like a real win to me.
Yep, absolutely. And this ties in, actually, we had a question in the chat just to clarify what we meant by platforms before, alongside brokers and I forget what else we said there. Channels like newsletters, but platform being like a listing platform. A lot of them actually are brokers themselves. Some are funding portals, basically a lightweight broker dealer for retail offerings. I think Reg CF and Reg A but not necessarily brokers. So they're not actively raising capital or syndicating deals, but allowing you to list compliantly and legally.
A lot of it comes down to the activities they're able to do, right? As we heard earlier, Reg CF platforms are only limited to several exemptions. Brokerage platforms, they have a lot more flexibility because they're licensed and regulated, and therefore they're able to do that. But as we saw with the Honeybricks case, that's a great example of a platform that not a broker, leveraging technology. The way they typically tend to operate is, you're not able to just jump into the website and see all this information. Usually you have to create a relationship with that company, create an account, and then maybe do some kind of verification before you can even see anything. They're all structured slightly differently, but I think the main takeaway is where it used to be reliant on brokerage platforms, and there are plenty that are modernizing to accommodate this. You don't necessarily have to rely on that.
Cool.
Yeah, well, let's go to the next slide.
All right.
Tell us
Okay,
about the
cool.
Hamilton Lane use
So
case.
Hamilton
Peter.
Lane, yep. So they have a handful of different funds now working with Securitize, with Figure, with Addix, with Alta over in Singapore. And essentially the whole thesis is just looking at lower subscription amounts, right? And this is something that I like to talk about, especially lately. It starts to make sense. But there's a whole thing about, these funds are still, the ones in Singapore, I believe, are for international accredited investors, which is fine. The ones in the US are for qualified purchasers. So even higher, even wealthier than accreds. So everyone makes the comment, what is this doing for democratization of finance? It's not doing anything. These are still very wealthy groups and professional investment firms that are gaining access. But that's a pretty surface level way to think of it. And if you think the institutions are going to make use of this tech to do kind of lowly raises, it's like there really needs to be some reasoning behind it, right? And so when you think about a QP, typically has $5 million in investable assets and up. I think the next level is really at 25 million. But if you look at a lot of traditional funds, even in the case of Hamilton Lane and what they've offered traditionally, that minimum buy-in amount, I believe, is anywhere from $1 million to $2 million. So if I'm a qualified purchaser with a $5 million portfolio, I'm expected to put a fifth of that into a single Hamilton Lane fund.
Not likely.
It's pretty tough, especially if the landscape has changed like it has so wildly the last 18 months, let's call it. And now credit is kind of the flavor of the week, to use that term. Now I have to rebalance my portfolio, and I'm still locked in at a minimum buy-in of $1 million. So either way, I need to sell a solid chunk of my portfolio. Again, it's not going to happen. But maybe I want to hit new allocation targets. Maybe I want even just a quick 2% of my portfolio to be in credit strategies. This is perfect. Security, and this is not a promo, but just a great example. It has Hamilton Lane Scope Fund, their senior credit opportunities product right now listed. I think $20,000 minimum buy-ins. Maybe I want to buy 50 or 100 grand of that for my client assets, for my portfolio, whatever. That makes so much sense, and that works right there. And the reason you can do that is because all the lower tickets, thanks to the back office efficiencies. Even if you have 100, 1,000 investors, you're not going to have to hire 10 people in the back office to manage that all. It's all on chain.
I think that's an extremely great way to put it. And to even add on to that, there's this concept of diversification in finance. The more you're spread out across different asset classes and markets your portfolio is, the less chance you have the whole thing tanking for one event, right? The ability to tap into lower investment minimums lets you tap into diversification on a larger scale, one that I don't think we've ever even seen before. That Wall Street's going to start taking advantage
It's all
of.
about newfound precision. That's how I look at tokenization.
That's a great way to put it. Now, again, hopefully that was useful to you. We wish we could keep on going, but now the next topic of liquidity, which I'm sure many of you are eager to get to, is up next. Of course, anytime, come apply at securitytokenadvisors.com so you can talk to Peter and myself, and we can help you out with your tokenization project. Mechanisms as we promised, but we've got a special treat for you where we're going to be hearing from Centrifuge, which is a whole different approach to this market that's quite unique. I'm looking forward to diving into it with Colin. But first, we mentioned earlier, Peter, there are a number of different ways that people are taking advantage of this tokenization from a liquidity perspective. Let's run through them.
Sure. So we see the most common, obviously the holy grail is at the end of the day, listing on an alternative trading system or an MTF, a digital securities exchange, depending on your jurisdiction. But really, this is the secondary trading venue that people think about when they hear, tokenized real estate, tokenized private equity, whatever. And it's definitely interesting. It definitely takes some legwork to get there. There are a number of listings as precedent, so it can be done. I think to really unlock liquidity, and it seems to be a more common theme these days that people are realizing, people meaning issuers, other platforms, industry providers, whatever, saying it really depends on how much we're actually disclosing on our, let's say, underlying asset performance. Are there big events that will actually incentivize trading? This is where the idea of, should tokenization really focus on real estate and PE funds that are more or less kind of slower vehicles, or should it focus on like sports teams and esports and anything kind of in the digital realm that has a lot of news that could come out kind of at any time, and all of a sudden that provides something for people, investors, maybe Herwig and myself, to trade against. But all that notwithstanding, there's still some solutions that could be put in place no matter what. And a couple of unique things that we see even, companies will sometimes offer the ATS approach for full listing, where they're actually the ATS venues matching orders on behalf of, aggregating all these client orders, bids and asks, buys and sells, and kind of matching those orders like any other venue would. Think of a NASDAQ or a large exchange, a marketplace, and that's what people tend to think of. But rather, the mid-ground may even be more of like a bulletin board approach, whereas maybe Herwig has 100 tokens, and he's just letting the world know, the world meaning other permissioned buyers, investors, holders, that, hey, I'm willing to sell, 10 of my shares, and I'm willing to take, $10 a token. And then should I come in and see, and I like that bid, maybe I'll accept it. If not, maybe it'll just sit there kind of. And it's not really like we're trading actively, but rather, okay, I'll grab his shares and boom, we just made a deal kind of right there through the bulletin board. This is nothing new per se, but rather we know, and what we've been talking about this whole time, technology wise, it can be facilitated quite quickly. Instant settlement, basically an atomic swap. I heard that word a couple times last 2 days. Always a great term. But this is like something that, is like a stepping stone to the full secondary trading marketplace that everyone's kind of after. And then, should you even get that far for a listing, a big question is how much volume is really happening behind the scenes, how many organic investors are really coming and trading, whether buying or selling in either direction. And something that needs to really be done. And, we preach this to our clients on the advisory side of STA. You really should have some sort of some sort of issuer managed liquidity if you can. The original goal, and maybe this is something we can get into a bit more with Colin soon, is even offering lending against your tokenized assets, your security tokens, to some way, shape, or form. You're not trading, but rather you are getting liquidity in the form of a loan. And it's a slightly different ball game, different risks, different things to be aware about. But that's par for the course, in this world. But rather something immediate is looking at yourself like a public company, if you will, offering maybe share buyback provisions, tender offers at certain prices. You can retire tokens. We've seen that done. If you were to get acquired, essentially the acquirer is buying out your token stack within the capital stack. So all these types of methods and kind of ways to at least provide liquidity potentially to your investors to give them some sort of confidence that their token is not just going to fluctuate with the wind, if you will.
Yeah, no, I think that's a great summary. I think I'll kind of point out where we are in this evolution of everything. I think no one's trying to hide the fact that the ATSs, these brokerage platforms, they've been on a journey, on a mission to build, robust liquidity on their platforms. But today it's not quite there. The volumes aren't there. And so we know that that's not necessarily that full liquid solution. And therefore, there are capabilities, thanks to tokenization, that make it super easy for an investor that if I'm on one of the platforms, I know Peter, his wallet or his identity, and we can make a trade thanks to the technology rails that we're both on, making it super easy for the issuer not to get involved. And that's a key between bulletin boards and some of these other use cases where again, there are certain licenses needed to get involved in certain liquidity activities like this. So a bulletin board by design is like a free-for-all for permission individuals to trade one another without intervention from any third party or from the issuer. Whereas I think that buyback model really is something that is not common, but we'll start to see become more common, because even doing buybacks or some kind of treasury management program for the shares, that's, again, so much easier to set up thanks to this technology that before you just really would never do it. And that's why I think we've been hearing all throughout the conference, the future angle of liquidity that I'm super excited about is without a doubt leverage. We saw this in traditional markets, real estate being a very illiquid asset, very, very deep lending industry behind real estate because of this, to enable liquidity, not through trading, but through leverage. We see this in crypto. We saw the rise of DeFi and how lending basically created a whole new life for the industry and use case to focus on. And now with tokenization for real world assets, for asset-backed securities and things like that, we now have a real opportunity to leverage this technology in this use case as well. And so we're going to start to see more and more of these platforms and partnerships form, so that if you decide to tokenize there, you're going to be able to hopefully tap into a lending solution like that for liquidity. And with that, I think that's a great transition, right, Peter? Let's bring on Colin from Centrifuge. They're really bringing on a whole new spin to everything. As he joins us here, I want to remind everybody that we talked about the primary market, how we tokenize, how we raise capital through that process. And we just talked about the secondary market. Oftentimes, there's actually a restriction period where there is no liquidity whatsoever from the primary to secondary. Again, there's issues with creating that secondary liquidity. Let's take a moment to understand a little bit more about how Centrifuge plays in this whole space.
Yeah, absolutely. And Peter and Herwig, thanks for having me. Peter, you said two things, and you as well, Herwig, that I just want to point out, which I think is one, kind of secondary market liquidity as like this concept of the stepping stone, right? And I'll address that in a moment. And then the second piece was just this idea of licenses, which I'll speak to as well, because we try and stay far away from that over on the Centrifuge side. So Centrifuge is a DeFi protocol, and what we are aspiring to be is the institutional platform for credit on chain. Now, as a DeFi protocol, what we're focused on is providing the necessary asset management infrastructure for issuers to tokenize and securitize a credit offering into 1, 2, 3, as many tranches as they'd like, and then issue that investment on chain. Through the Centrifuge protocol and through our platform, through integrations that we have with partners like MakerDAO and Aave, an issuer, a credit fund, an asset originator, an asset manager, then has the ability to access kind of the world of small but nascent and growing on-chain capital markets via Centrifuge. Now, like you've said, I think it's important to point out that as a DeFi protocol, we don't really have licenses, right? So there is no secondary market trading involved or around the Centrifuge protocol. And the second piece is that most of the tokens that are issued today on the Centrifuge protocol are either Reg D or Reg S security tokens. So very much in line with a lot of the language that you guys were just using. From a story and a history perspective, Centrifuge has been around 6 years. I would say we're probably the leading real-world asset protocol in DeFi at this point in time. And we're most known for our relationship with MakerDAO, the largest decentralized stablecoin, DAI, which I think is hovering at like 6 and $6.5 billion right now in circulation. And then also a relationship with Aave, which is also a pretty well-known household name in crypto.
It's an impressive ecosystem you've built. Pretend that, I'm brand new to tokenization. I've heard all this talk about, the capital markets and Wall Street kind of transforming, but you're absolutely coming in from a different angle. This term DeFi even scares a lot of people. You've done a lot of work to make this mechanism in place. Tell us a little bit more about how you're capturing this new audience to come to Centrifuge.
Yeah, so I think where I am finding, or where we're seeing a lot of the interest is, I think on two fronts. The first is a key partner and investor in the Centrifuge protocol is Block Tower. And over the last 6 months, they launched, even longer than that now, they launched the Block Tower Credit Fund. And that is using the Centrifuge protocol to issue and manage traditional structured credit. The reason they use the Centrifuge protocol is because they were able to access and tap into MakerDAO liquidity there. And so MakerDAO actually provided Block Tower with a $150 million credit line for their credit fund. It's kind of like the sole sponsor of their credit fund. I think that's an important and kind of a defining story for two reasons. One, Block Tower for me, and I think for a lot of the people in our industry, it represented conviction around what a DeFi protocol can do, right? Versus having to go through, if you think about like kind of the macro conversation, what we saw over the last 2 or 3 years is this conversation around very insular private blockchains, right? Built within banks or built within TradFi, but just using blockchain technology, but in a very traditional manner. By Block Tower kind of adopting our technology, incorporating it and using it to launch their own credit fund, I think it showed people a pathway, right? That this can actually be done, and gave some of the more traditional issuers and asset managers just a heads up that it can be done. It's not, it's not easy. It's not right out of the box just yet, but it can be done. I think the second thing that it kind of proves out, and I'm seeing this happen time and time again, is this idea of growing capital markets on chain. Again, with everything that's happened in crypto over the past 2 years and where interest rates are and where the world is broadly, crypto capital markets are probably the last thing on people's mind. But when you think about any good asset manager or any credit manager, especially the smaller ones, right? 2, 3, 400, $500 million in AUM and trying to grow, they're going to have to be innovative in order to compete with your large, massive, multi-billion, 10, 20, 40, $50 billion credit funds that are out there. And those innovative credit managers, we're talking to them, right? And I don't think we're the only ones talking to them. I think there's a lot of DeFi protocols talking to them because they're willing, I guess, to go on the journey, right? And go through the effort of understanding how these capital markets are forming and how to access them via these tokenization platforms for primary issuance and investment from these parties, because it kind of gives them a pathway and a potential leg up should markets correct, or should they be able to open up relationships in the way that someone like Block Tower has with MakerDAO.
No, that's really illuminating. If I get that right, depending, of course, on the exemption that's used, I'm able to go to Centrifuge and participate in something like the Block Tower credit fund, and then I can actually leverage that with, say, MakerDAO or OV. Is that what I'm getting right? Or
so this is where the simple use case is to structure credit using the Centrifuge protocol. So you can open up a simple senior junior tranche of an investment vehicle using the Centrifuge protocol. And now that investment is available on the Centrifuge blockchain and through the Centrifuge application, you then have the ability to access any investor that's used that is crypto enabled. But you're typically only going to be accessing accredited investors that are KYC'd and AML'd, right? And the reason for this is because depending on the issuer, right, or the quality of the asset originator, the manager, or the structure of the investment, they're probably issuing Reg D or Reg S securities, right? And so it's only going to a KYC'd AML'd audience that is typically accredited. There isn't leverage on these tokens right now from a Centrifuge perspective. And these security tokens, people are simply holding them for principal plus interest. I can tell you that, when it comes to liquidity, I think this is the conversation that I would say precedes any conversation around asset management infrastructure, right? It is, if we're going to use a tokenization platform to come on chain, we need to know first, from a primary capital markets perspective, what's the ability to access capital on chain? What does that look like? How do we do it? It's so different than the way we have traditionally thought about this. Who do we engage with? How do we engage with? It's a bit opaque, and I think that's an effort by the industry collectively to try and make it a bit more clear how to come on chain and kind of do it yourself, if you will. But then really the second piece is, and this is a question that doesn't really come from the sell side, but it comes from the on-chain buy side, right? So if you're any type of on-chain investor, right, given what's happening in crypto and given what's going on with rates in the market environment, you want liquidity. And so it's very hard for these longer dated, longer term, esoteric private credit, long tail investment offerings to find demand on chain today without an investor having secondary market liquidity around that asset class or around that investment offering. And markets, I think, are far more hard to create, or take longer to create, perhaps. I'm not a technologist, so I shouldn't speak to technology, but creating these markets, kind of the point you made, Herwig, around the demand, right, or the amount of flow going through the ATS and the bulletin boards, right? I think that's a really big question for the on-chain investor right now. What kind of liquidity exists if I buy into this, 1 to 2 year dated or duration product, right, where there is no redemption within the 12-month period? Like, what am I really signing up for? What's going to happen in the next year? How do I get my head around that? How do I make a good investment decision here without any liquidity around this investment? So for me, I think if in order for the tokenization of traditional assets on chain, which we call real world assets, to really flourish, secondary market liquidity is absolutely critical.
Yeah. What, Colin, do you know what I don't want to say average deal size is through Centrifuge, but like any insights on the investor profiles? So not even the issuer, but what the actual buy side, the demand side looks like. Very curious. I think a lot of people are curious in general. Like the common question, who's buying these money market funds? Who's buying these treasuries? We got some insight yesterday. So I'm very curious from your angle, if you guys see any profiles or recurring themes.
Sure. I mean, I think as much as we all like to talk about like the institutional adoption of the blockchain or crypto, that's not happening right now, at least on the buy side, right? So anyone that's thinking about this as a pathway to innovative or risk-seeking institutional investors, which I guess doesn't even really exist, right? Like risk-seeking institutional investors, that's not really happening right now. I do think a lot of the pathways to on-chain capital markets right now are through ecosystem type partnerships, right? So you can think a lot about the treasuries of some of the DAOs that have been amassed over the last 2 to 3 years, right? And some of the protocols that exist. Some of the ecosystems are rather large. Like it's probably been discussed in the past 3 days, guys, but even someone like Avalanche and their Vista program and the $50 million offering or kind of investment fund that they've put together. There's I think these types of ecosystems, Base, Polygon, Arbitrum, all of them kind of represent not only blockchains, whether they be L1s, L2s, or otherwise, that have been successful in front of kind of your traditional blockchain venture capital crowd. They've also built incredible networks of users that also have their own pockets and pools of capital. And one of the beautiful things, I guess not beautiful, but I guess just like an outcome of what's happened over the past 2 years in crypto is that because of yield has been hard to find on chain, it's created a vacuum for yield. And so, like you said, like these tokenized money markets, these tokenized treasury offerings have flourished and quite quickly, relative to the rest of the market. And I think that represents that the capital is there. And I think our take at Centrifuge is that even with treasuries, right, as rates correct, right, I think we still have a lot of work to do to close the educational gap and the understanding gap between kind of the way the crypto native on-chain investor thinks versus the way the traditional off-chain investor thinks. And just to narrate that for a second, the traditional off-chain investor has access to the entire world of investments, right? So when they look at crypto, it's just the smallest slice of the entire portfolio of assets that they could be investing into or building. Your on-chain investor is to some degree limited, right, by what's tokenized and what's brought to them. And so as a real world asset platform and as a tokenization platform, we feel a compelling kind of like reason to not only spend the time bringing the assets on chain and helping build the technology and the ecosystem around those assets for the primary issuance, right? Because that does feed into the secondary markets that we're talking about here and that liquidity, but also spending time with your, the on-chain crypto investor that's trying to get up the investment management curve and understand a bit more about what real world assets are and how they can access them in a reputable way.
Now, naturally, you're building a marketplace of sorts by catering to multiple sides here. What is your biggest focus for 2024? Is it providing more credit options and working with more issuers to make that available to investors? Is it attracting more on-chain money to the platform? What would you say is the most important thing in order to kind of move your vision forward? Perhaps even liquidity and starting to figure out those partnerships somehow. What would you say is your biggest priority?
I think the first thing is we want to be the most trusted place for your crypto native on-chain investor, not retail, not an individual, but a true organization, right? Some organized pocket of capital to feel that they can in a safe and methodical way, make an investment decision into a real world asset investment through the Centrifuge platform. That's kind of, I think, step one. I think step two is making sure that Centrifuge is available wherever those investors want to access it, right? So there's so many different blockchains, there's so many different ecosystems, and they'll only proliferate over time. They'll all be interconnected and composable. But the investor is ultimately going to want to experience and allocate to assets in a way that is most comfortable and most and within their own environments. So we need to meet them where they are. So bringing Centrifuge to them versus asking them to come over to the Centrifuge chain or the Centrifuge application is the second key driver. And the third thing is when you think about the types of assets that sit on Centrifuge, the issuers that are issuing those assets and how it's being managed, how transparently what legal is underlying the investment itself, what kind of service providers, right, that you would expect in any traditional investment class, whether if it sits out off chain, is around that investment, making sure that's as institutional as possible and that the assets are of a quality that would meet an investor's demand. And the final point is just making sure that the platform itself as Centrifuge is completely diversified from a risk return spectrum. So you can access different asset classes in different jurisdictions across the yield and across the risk curve.
Yeah. Do you think there might one day be something like a basket product, or just because of how easy it is to pick and choose, there really isn't any need for something like that?
It's funny. I think about that and I think about secondary markets, like a basket or like an index, right? I think about those as, do you build it yourself or does someone build it for you? And you just try to be the best underlying in that case. I think that's a real, a buy or build question, not us buying, but I guess like partner or build it yourself, if you will. So I'm not sure, but I do think there's already a couple of products like that and a couple of different businesses going at that model. I do think that model right now, I'm sure it's a bit of a timing game for them, much like it is for the ATSs, right? And what you spoke to about how much flow is actually coming through here. How do we generate more flow? For us at Centrifuge, before we get to those questions, we want to have the right partners in place as we grow and as we scale. I think it's most important to think about how do we just tokenize and bring the right investments on chain at the asset level to fuel the ecosystem. Because ultimately, whether it's secondary market trading or index building or basket building, it's all going to be dependent on the quality of the assets and how they're issued and how they're managed.
Absolutely, the quality and the number, which you're clearly focused on increasing, so that I think organically that would eventually, whether you do it or partner up, I would imagine that would be an inevitable growth to help even further, maybe with the liquidity or accelerate that industry. But I think you're right, you're spot on. And this is just to highlight to everybody, that's how early we are. And centrifuge is right in the thick of it. I don't even want to go into the regulatory challenges of how you've managed to make this platform so that even accredited investors as well as international can participate. I'm sure one day y'all will figure it out too, to make it retail US as well, if you're not already. But we don't have too much time left. Is there anything you want to share with the audience you think they should absolutely take away that you haven't been able to cover yet?
I think the only thing I would impart to the audience is that I actually think most of the actors inside of DeFi, right, and most of the crypto native groups that I know and work with every day are really putting their best foot forward to try and do this as buttoned up and as institutionally sound, right, and to fit within the jurisdictions or the regs or the policies within whatever country or region of the world that they're operating within. And for those on the call or for those here that are more traditional in nature, we need your help, right? If you actually believe in what the technology can do and you believe in what things like the blockchain and smart contracts and all of these different pieces of the technology stack can do, we need more institutional thinking. We need more institutional rigor, and we need it across the board. And one thing I would encourage people to look at is something that's called the Tokenized Asset Coalition, something that we've, launched and, are welcoming any and all to kind of help us think about, which is just how do we build the right frameworks and the right institutional practices within crypto around this tokenized asset movement to really scale it over the next X amount of years. So, and really appreciate you guys having me on today. It's been really great, and appreciate the questions and the platform.
We appreciate you being able to join us and give us that insight. I think that's a fantastic message, right? It's even with the whole industry, we've been afflicted by bad actors and the lack of, regulatory modernization or just even understanding to catch up to it. But DeFi is totally doable. The technology is phenomenal. Centrifuge is already doing it. So absolutely, institutions, please hear Colin's call and come learn about how this technology works and come leverage it. Come check out Centrifuge. With that, we're going to wrap up Tokenize This in just a few minutes. Thank you again, Colin, for joining us for our last session here.
Thanks, guys. I really appreciate it.
Cheers. Right on. Hello, tokenizers. We did it. We just had 3 full days of amazing tokenization sessions. I have without a doubt that there are people looking at starting their own platform, starting their own token projects, potentially investing and getting involved in the space, from big asset managers to investment banks to real estate entrepreneurs to alternative asset managers to private markets to credit and everything else we discussed. You're seeing it get transformed. Obviously, if you didn't get a chance to look at every session throughout the last 3 days, we will have the recordings available on the Zoom platform, as well as they will be produced and released on our YouTube channel in the future for you to visit at any time and hopefully use for whatever that it is that you're working on. Again, thank you to everybody who joined us all 3 days or even just for a minute. This was, again, the biggest possibly online congregation for tokenization. Over 1,000 people tuned in. Hundreds of you were active in the lobby and engaging with each other in the networking. We saw a lot of amazing predictions and a lot of insights get dropped by some of the biggest blockchains, biggest brokers, biggest banks in the world. I just couldn't be more elated with the turnout. I feel the love. I'm so excited to announce that, of course, because of how successful Tokenize This was virtually, we're just going to have to hear the call, and do it physically. Nowhere better than Miami itself next year, April 11th through 13th. Tokenize This 2024 will be live. Anyone who has been to any of the North American Bitcoin conferences in the past can already guess where the venue might be, but tickets will go on later this year. So go and join the waitlist to summit.stm.com to register for free and get more information as we go about it. And of course, let us know if you want to participate, collaborate, get the word out. We want to make this the biggest physical conference and congregation of tokenization in the world. Again, please join us, and thank you so much for all of the support, and reach out to me anytime you want any help for anything related to tokenization.